Hi, everyone, and welcome to day 2 of Emerge Live. My name is Laura Barger, and I'm the Chief Marketing Officer at the Financial Health Network. For those of you who were here with us yesterday, welcome back. If you're just tuning in for the first time, thank you so much for joining us. We spent our time yesterday discussing topics related to the theme of redefining livelihoods, with dynamic conversations on worker financial health and the opportunities for leaders across institutions and industries to help employees build resilience and thrive. Today's theme is stabilizing communities, and today's agenda focuses on what we collectively should be doing to help our most vulnerable communities recover and rebuild from times of crises. Before we begin, I'd like to just run through a few tips and housekeeping items. If you're watching today's live stream from the Emerge Live website, please take a minute to check out all of the related content that we've highlighted and included on today's page. It will give you additional context to some of the topics discussed and a way to follow up for more information. Related to this, if you missed yesterday's sessions, we've posted the content at the bottom of this live page. Just go to the related content and look for day 1 to view. We've included a chat function that will be enabled throughout the week. You can see the chat box right here on the Emerge Live page. Feel free to engage in discussion and ask questions throughout the day. But please note that some sessions may be able to address some questions while others might not. We'll do our best to answer as many as we can. Closed captioning is available throughout the week, provided by the World Institute on Disability. Please see the link above the schedule to access this feature. And finally, please let us know what you think. You'll find a link to our daily survey just above the schedule on this page. Your feedback is so important to us, and it will help us continue to deliver a great experience to all of you. We hope that today's sessions will spark ideas and conversations in your homes, your workplaces, and across your networks. Please feel free to share your thoughts on social media and encourage friends and coworkers to join us today and through the rest of the week. Thank you again to our sponsors who have stepped up to support and encourage these important conversations. Thank you to our diamond sponsors, JPMorgan Chase and Prudential Financial, our financial health sponsor, the MetLife Foundation, our gold sponsors, AARP Foundation, BlackRock, PayPal, and Wells Fargo, our silver sponsors, Bank of America, Intuit, and Fifth Third Bank, and our bronze sponsors, Capital One, Marcus by Goldman Sachs, Members Development Company, the National Credit Union Foundation, and Opportune. Today's session begins with the Financial Health Network's founder and CEO, Jennifer Tescher, in a conversation with Raul Vasquez, CEO of Opportune, on the role of inclusive, affordable financial services in stabilizing vulnerable communities. We sincerely hope that you enjoy the day.
Hi, I'm Jennifer Tescher, founder and CEO of the Financial Health Network. Great to see you back with us today. I'm joined this morning by Raul Vasquez, the Chief Executive Officer of Opportune. Welcome, Raul.
Thank you, Jennifer.
So I think you are in your offices in Silicon Valley, yes?
I am. It is I think, arguably one of the safest places in California because there are only 2 to 3 people here, and the Wi-Fi is much more reliable than it is at my home with teenagers.
Excellent. I totally understand where you're coming from. So while I think that a lot of people know who you are, I don't want to take that for granted. We have a really broad audience today. So why don't we start by having you tell folks a little bit more about the company?
Sure. So we are a mission-driven community development financial institution that provides inclusive, affordable financial services. And the way that we do that is we are really focused on taking a deep data-driven understanding of our customer and applying advanced technology and data analytics to that. And what that's allowed us to do over the years is we have been able to provide installment loans. We've added auto loans recently, and we've added credit cards. We lend a range of $300 to $10,000. And in our 15 years of lending, we have now been able to lend almost $9 billion to 1.7 million customers. And we've helped 850,000 people with credit scores.
Wow. Talk a little bit more about that last part, helping to build credit scores. I know when the company was founded and through to today, the focus has really been on reaching underserved or harder to reach customers, particularly in the beginning, Latinx customers. Is that still true today? And of the folks who are coming to Opportune, generally speaking, what percentage of them would not be able to get a loan elsewhere because of not having a credit score or having a limited credit history?
So historically, what we've seen is about half of the customers when they first come to see us don't have a credit score. And as a consequence, they're not really able to go to a mainstream financial services provider. They're basically shut out of the mainstream financial system. So what we've really been able to do is amass a fantastic team of people that want to be of service to others. And that includes engineers, data scientists, marketers, everyone. And one of the things we've had to do, to your point, Jen, is we've had to figure out, how do you score the unscorable? How is it that you can collect enough information to make a responsible lending decision to individuals who others either don't want to lend to or can't lend to? We did focus primarily on the Latino community, and that was true when I joined the company 8 years ago. But kind of deep in the mission were the ideas of inclusion, belief, wanting to provide opportunity to others. And we really felt that the skills and capabilities that we had developed, that we were focused on providing to the Latino community, could really apply to anyone who had that need, right? Anyone who really needed an opportunity and a chance. And we've really been expanding the business over the years to help anyone, really.
Well, and that really is fitting point to talk about the racial inequities that we as a nation are grappling with again today. What kind of inequities have you seen and have been trying to fight against, essentially, in consumer lending? And is there anything new or different that this moment means for the company?
So I think I grew up in El Paso, Texas, which is not an affluent community. And part of the reason that I wanted to join the company was I really felt like the customers were my cousins, my friends. If things had gone a little differently, it'd be my parents and my siblings. And what I really felt I had seen, and that we continue to see today, are inequities in access to capital, in people's experience with mainstream financial products, in their exposure to financial concepts, because sometimes even if you have experience, you may not fully understand how all the concepts work. Access to responsible products and pricing. There are times when the need is so great that you'll take any product, and access itself can be helpful, but really what one wants to do is have access to things that are going to be helpful, to products that are responsibly structured and priced. And then finally, access to service support. So for example, we knew when our customers started to lose their jobs that one of the things that we're going to have to do was to figure out how are they going to make the math work, in their lives. And that part of that may be reaching out to lenders and asking for a bit more time. So we were very committed to picking up the phone within 10 seconds And that's the kind of service and support that generally a prime or a super prime customer gets. And we wanted to bring it to low and moderate income consumers. So those are all the areas where I think there's been inequality in terms of a low to moderate income consumer in financial services. And right now, I think what we're really seeing is we're seeing a spotlight on virtually all elements of that. Because right now, our customers have lost their jobs. They may need capital, and they don't necessarily have access to those great products or access to that service and support.
And as we know, but I think it's worth repeating, is that people of color are disproportionately more likely to lack a credit score or to be low and moderate income. So just by dint of your broader mission, you're more likely to be serving communities of color.
Yes, we are. And we have 342 locations right now in 9 states. And they are in those low and moderate income communities that generally don't get access to capital. I mentioned earlier that we are a community development financial institution. People in the audience may not be aware of that designation, but it's something that the Treasury Department provides to organizations that are fundamentally strengthening communities. And one of the ways that you can get this designation is to demonstrate that you are providing capital to those communities that don't necessarily or don't easily have access to it, and that you're doing it in a way that is going to strengthen that community. We've been a CDFI now for over 10 years, and part of it is that almost $9 billion that we've been able to provide to these communities that, to your point, Jen, tend to be low and moderate income and tend to be communities of color.
Yeah. So you started down the path of talking about how your customers are experiencing the results of COVID and the economic fallout. Why don't you tell us a little bit more about what you're seeing, what you're hearing from your customers?
So what we're seeing is our customers were among the first to lose their jobs. So in really the middle of March, as California, New York, as a lot of places started to put shelter in place provisions in the economy and in society, that was really when the layoffs started to take place. And we very quickly, within a few days, started to get a lot more inbound calls. And we started to reach out to a lot of customers to try to figure out if they need help. Our approach in terms of servicing and support has always been to get in contact with the customer, figure out if something happened that has led to a delinquency, and figure out how we can be helpful and give them enough time to get back on their feet and to be able to pay us back. So very, very quickly in mid-March, we did see that our customers were among the first to lose their jobs. The next thing that we saw was really an urgent need for support of people saying, I need 30 days to try to find another job. And after 30 days, in many cases, they've asked for yet another 30 days. And we've been there to try to help them with that. And then unfortunately, clearly, what we've also seen is that these communities of color and our customers are over-indexing in the likelihood to have to deal with COVID-19, to be hospitalized, and unfortunately, fatalities. So we're really focused on trying to make sure that we're doing everything we can to continue to strengthen communities and continue to be there for our customers, because we know our customers are resilient. We know they're the heroes that are at the front lines, keeping us fed, keeping us safe, keeping all of us well provisioned. So we want to make sure that we're there for them in this difficult time.
In a way, it feels like you have been on the leading edge or the bleeding edge of the pain that some communities are facing. There's been a lot of discussion now about how the additional unemployment stimulus is about to end, and increasingly a number of the programs that people have availed themselves of to defer loan payments, to take forbearance, may be coming to an end. How long do you think lenders should go in trying to provide people some relief in this moment? What do you think is realistic? You are a publicly traded company. There are rules about how long you can carry impaired debt. Talk to me a little bit about, not just for you, but sort of writ large, how you think the lending community needs to be approaching that.
Yeah. I think this is a time to try to think long-term. This is a time I think in which these ideas of inclusive capitalism and not just being focused on shareholders, but being focused on stakeholders broadly, right, including customers and communities, that idea is going to be tested to try to figure out, are these just words, or is this something that, you know, the different leaders in different companies are committed to? One of our board members shared with me an expression that I keep thinking a lot about during these times, which is, don't let what you see cloud your vision. And what we're really focused on right now is seeing the heroism of our customers, seeing how resilient they are. And because when we lent in the last recession, knowing that they are trustworthy and they are reliable, but they may just be dealing with the effect right now of a horrific situation, right, across their jobs, across their health, and just giving them enough time. So I'll tell you what I hope the financial services industry does is that they think about long-term value, that they think about long-term relationships, and that they're not just solving for the P&L of this quarter or the next quarter, but that they're thinking that if they stand by that customer today, that customer is going to remember and that customer is going to reward them over the long term. That's how we're thinking about it. We've worked with the people that lend us capital and let them know that we're going to be there for our customers, and we're going to demonstrate care and compassion by believing in them. And if they tell us that they've lost their job, we don't ask them to prove it. We say, okay, why don't we go ahead and delay your payments? Or why don't we, if you can make a payment, let's figure out a way to restructure your loan so that way we don't make their life harder. We can provide them with a solution that gives them a bit more breathing room.
So let's talk a little bit about the effects of credit in terms of stabilizing a customer or a community. You've talked a lot about one of the hallmarks of what Opportunity has always been about is creating that access. How is credit a stabilizer? And in what situations is it not a stabilizer anymore?
So credit is, it's so interesting because it's a thing that so many people and businesses take for granted. But the power of credit, I think, is that it allows you today to have access to a resource or to something you want that you could not afford if you had to pay for all of it today. So as a consequence, credit allows you to get that benefit while paying over time, right? So credit can be a stabilizer if you have an emergency that arises and you don't have enough savings to be able to pay for whatever that service is that you need. Think of a loved one being hospitalized, right? Which clearly is happening a lot right now. Think of a car that doesn't start in the morning, or one of the things we know is there are a lot of multi-generational families that we serve. And that can also be a contributor to the spread of the disease. So if someone wants to go ahead and say, you know what, why don't we get another apartment and maybe spread out a little bit? They may not have enough money for deposit, but a loan can help with that as well. So that is where credit can be a stabilizer, is it can help a family, it can help a community absorb shocks. And then the same is true on the business side in terms of allowing individuals to pursue an entrepreneurial dream. How is it that they can afford the tools or the equipment or the labor that they're going to need to go ahead and start their business? Today, we're focused on consumer lending, but from a mission perspective, we've talked for years about wanting to do small business lending. And this is a reminder of how powerful capital can be in those low and moderate income communities to also allow someone to start a business, help them create wealth, help them create employment opportunities in communities.
I'm gonna come back to you on the question of when is credit not a stabilizer. But before we go there, we've had a couple of questions from the audience. One person was asking, are you using a network of lenders or do you do the lending yourself? I believe the answer is the latter, but you might want to just describe a little bit about what the customer experience is like, both physically and virtually.
Sure. So let me talk a little bit about our customer. Our customer on average earns about $45,000. Half of them are supporting a family with that very meager income, very modest income. And we know that they may be working more than one job. So one of the things that we were always very focused on was trying to make our service as accessible and as convenient as possible. while also adding elements of financial education and helping a customer understand the structure of our product and the obligation that they were about to enter with us. So we basically serve a customer through online. If someone is going to their computer or their mobile phone and doing everything themselves, let's say because they have 2 jobs, they've got a family and they don't have a lot of time to come see us or to talk to someone, we're happy to serve them that way and they can do it end to end. As you can imagine, with shelter in place, we've got more and more people using that online channel that we provide to be able to get a loan from us. If a customer maybe has questions because they've never had a formal loan, they've only borrowed from friends, and they really want to understand how our product works, they can come to one of our 342 locations. Those locations are either in a place like the Mission District in San Francisco, where we'll have a standalone location that will be where our customer lives, where they work. Some of our locations are in grocery stores, a place where our customers are accustomed to coming frequently. And that really gives us an opportunity to explain our product and even to take payments in cash. Our customers have historically made about 40% of their payments in cash because they're comfortable in the cash economy, and we're happy to take their payment. And then if a customer, say, wants to call us over the phone, they don't have time to come in, but they do want to speak to someone and have their questions answered, we've got contact centers that are available 7 days a week. And customers can use the channels in any combination. So that's how we work with the customer. And it's really about how do you meet the customer where they are and do it in a way that is going to be understanding in terms of any doubts or concerns they may have or any handholding that they want to enable, right, or take advantage of in entering this formal financial contract with us. And it's all our lending, yes, not through other partners.
So when Opportune started, you were only physical, and it was quite some time ago. It was pre-iPhone when the company started. So that makes sense. And the notion of the interpersonal, I know, was a big part of the DNA. Obviously, times have changed, and you have now a mix of channels, both virtual and physical. I think there's always a lot of talk about high tech versus high touch in providing financial products and services, particularly to lower income customers, people who may not have had a lot of experience with the system before. And as you said, that's being tested right now with shelter in place. I wonder if you can describe whether you've seen any changes in your customer behavior. Like, for instance, you mentioned that in the past, you were seeing upwards of 40% of your customers pay in cash in person.
Right.
What is that looking like now? And do you think that this experience of COVID will change the mix, that maybe some of your customers aren't going to need the in-person as much anymore? Or maybe you'll think differently about your mix of stores versus virtual?
Yeah, so I think I'd start by saying, we really try to think in terms of ands, not ors. So that this idea of high touch versus technology, we think is a false choice. I mentioned at the beginning, we're really powered by a deep understanding of our customer, and then we add a lot of technology to that. We believe that being in the communities that our customers live in give us a lot of insight into the customer and help us serve them better. And we believe, to your point, that even during this difficult time, that there continues to be a role for a physical place where you meet someone. So historically, about 40% of our payments have come in cash. We have seen traffic decrease because of shelter in place, but we've still had over 30% of our payments come in cash. Even in these times, customers prefer to come see us and pay us in cash and talk to someone in person, either for an application or a payment. So we have kept our locations open. We've been part of the critical services infrastructure. And the insight that we're gaining as we talk to customers and as we talk to our employees who are members of the same community helps us serve our customer better. And it helps us develop the technology in a way that is going to be more useful to our customer.
I'm looking at some audience questions here. There's a question about what's your underwriting process? So in other words, how are you creatively assessing a customer's ability to repay? especially given that half your customers don't have a credit score or other traditional kinds of assets or collateral?
Right. So I'll start by saying we didn't touch on this earlier, but some work we did with the Financial Health Network was very helpful in helping us understand how our rates and costs compare to others. And the work that we've done has helped us understand that we charge on average 1/4 of what others charge our customers for credit, and compared to payday, it is 1/7. On a dollar basis, that's about $1,000 in savings on just the first loan. And as a consequence, we tried to be very focused in terms of having a good understanding of who are we best suited to serve, and trying to be as efficient as possible. And I bring that up because it'll help explain the process that we go through. So the very beginning of the process is asking for a little bit of information so that we can try to query the bureaus and understand, are you in the bureaus already? I mentioned that half of the customers when they first come to us are not, the other half are. So the very first thing we try to understand is, what is your experience with credit? If you've had a lot of experience with credit and for a variety of reasons it hasn't worked out, we are going to tell you that we're sorry, but we're not the best person to lend to you. And that's because our models are not tuned to that person that's had a lot of experience with credit. Our models are really tuned for people that have had little experience or no experience with credit. And as a consequence, right away, out of respect for the customer's time, and so we can be efficient, if you have had that experience, we'll turn you away and let you know that there are other people that are more likely to be able to help you. That focus then allows us to continue the process and ask a customer, where do you work? Where do you live? How long have you worked there? How long have you lived there? And other information about their income and expenses, so we can start to get a sense of a person's cash flow. Once we collect that information, we enter then the next step of the process. And at that point, that all that technology I mentioned earlier, we've got data scientists, we've got engineers, risk analysts, a lot of really talented people. And what they do is they've created an engine that at that point in the process goes out and looks for a tremendous amount of alternative data, brings that all back. And with that, we've created a risk tree that ultimately lets us know, are we going to lend to you, yes or no? And if so, how much?
Give some examples of what that alternative credit data looks like.
I'll give two that we share publicly. One is, if you're a prime or a super prime customer, chances are that you've had your cell phone for a long period of time. You haven't changed your number. You've never been in a situation where financially things have gotten so tough that maybe you had to walk away from your cell phone bill. So one of the things that we try to understand is, how long have you had your cell phone? Because it can be a signal of your willingness and ability to pay over time. A second one is, when you have a mortgage, your mortgage provider reports to the credit bureaus. And that can give us a sense of how long have you made timely payments on your mortgage. But the overwhelming majority of our customers do not own a home, they rent. And renters generally don't have their performance reported to the credit bureaus. And this is where you have a chicken and the egg problem. You can't really have access to responsible credit, right, until someone has reported that you're a responsible borrower, and no one's going to report that you're a responsible borrower generally until you've had access to a mainstream financial services product. But now there are more and more data sources where you can go out and you can figure out, oh, Jennifer has been renting. She's been renting at this place for 6 years, and she's a phenomenal payer of her rent. She is very, very timely. And that can be another signal for us, for example, right, of your ability and willingness to pay. But we look for a lot of signals like those. We bring that back and we create our own proprietary scores. And if it's available, we'll combine it with information from the credit bureaus to make a lending decision.
So you mentioned that your underwriting process is tuned to people who haven't really had a lot of experience. But I know that you are keen to keep lending to those people over time, particularly as they build experience. So how do you sort of manage that, given that on the front end for a first-time customer, you're not looking for folks who've had a lot of experience?
So that we seek to serve 100 million in the US, 100 million individuals in the United States who either don't have a credit score, or we think the bureaus are fundamentally misscoring them. And the 15 plus years of experience has given us a chance to differentiate between those 45 million people who don't have the score and then the 55 million people who just aren't being served well by mainstream institutions because the Bureau doesn't accurately portray who they are. So to your point, that first loan may be to someone who doesn't have a credit score. And after 6 or 7 months of working with us and having us report to the Bureau, they'll get a score. At that point, they go from being invisible to every large institution who knows how to mine the Bureau starts marketing to them. If that customer decides at that point to work with someone else, we think we've done a wonderful thing from a mission perspective because that customer now has choice and they have experience with a product, with a financial services product. We think that experience is really critical. I know a lot of people talk about financial literacy. And the thing I think about is there's only so much I can read about driving a car. At some point, I've got to get behind the wheel to really understand how it works. And we think that that experience is really either if they choose to stay with us, which was your question, and I'll get to that in a second, or if they choose to go and work with someone else. And from a mission perspective, then we think we've done a great thing because we've provided that expanded choice set and expanded access. If a customer is so happy with our service, and by the way, our net promoter scores are on par with the Ritz-Carlton, with Nordstrom, with Netflix, with Apple, with Amazon, with companies that we generally hold in high regard as consumers. If a customer chooses to stay with us, what we do is we give them access to more capital, if that makes sense, by extending the term, and we drop their rate. One of the principles that you and other organizations have articulated of responsible lending is a customer should see a benefit from performing well on their loan, and we absolutely agree with you. And that's part of the way that we earn the right to keep serving our customers. And that's how we think about it. Once they've got a credit score, then we've got to really compete with the Wells Fargos, with credit unions and others, and we have to earn the right to be able to hold on to that customer and have them choose to stay with us.
Thanks. Let's go back now to the question I posed earlier about when is credit a stabilizer and when it is not. That's a tricky question. And I know your borrowers, you ask for a reason that they're borrowing, but at the end of the day, right, honor system, people
Yes.
might be using the money for whatever they want. And also, you know, we're at a moment in the cycle where even though people deleveraged significantly post 2008, most of that deleveraging was on the mortgage side of the house. And credit card and auto loan and student loans are, you know, back at levels that we haven't seen since that last crisis. But at the same time, also, we're seeing lenders understandably pull back in this time when people have less income coming in. In fact, someone specifically asked from the audience, have you pulled back on deploying credit right now in this moment? So how do you think about all of that, right? You've got conflicting messages coming at you. How do you make sense of all of that?
Sure. So we've created a business where we have sought to align very closely with the customer. And what I mean by that is if a customer is successful, then we're successful. And our best and most profitable loan is a loan that is never delinquent and that is either paid on time or even paid early, right? Delinquency for us is not a profit center. And that's very different than the way that some other businesses are structured and some other products are structured. So for example, one of the criticisms of payday is that a lot of the revenue is generated by the product actually not getting paid back, but instead being extended over and over and over again. And I am a believer that design is a reflection of intent. So we have designed a product so that a customer can feel that it is affordable and that they will be able to pay us back without being delinquent. So what that means is going back to when is a loan not a stabilizer? We mentioned that the power of capital is allowing you to buy something today or to take care of a problem today that you would not otherwise be able to do and being able to make that payment over time, right? In that case, it is a responsible product. If you're able to pay it over time without creating hardship in other parts of your life, then it is that stabilizer. If it is a product that is not structured to allow you to do that, either because it's got prepayment penalties, or the payments are so high that you're not going to be able to afford them without creating hardship, or there's a big balloon payment at the end that means you're going to have a hard time, then it is not a stabilizing force, and it is going to create anxiety and stress and hardship in other parts of your life. In addition to that, if the lender is reporting to the bureaus on a product that was not structured for success, it is not only going to hurt your ability to get access to financial products in the future, but some states pull credit scores as part of making an employment offer, right? A lot of renters or people that are providing rental properties also pull credit to decide if they're going to rent a place to you. So entering into a poorly structured product can destabilize not just your access to other products, but your access to employment, your access to residences. So that's where we really think that design, right? The design of a product to ensure that it is responsible and affordable is critical to ensure that it is a stabilizing and positive force.
I'm going to try to get an accord done of my own now.
Okay.
So it's really interesting to think about Opportune in this moment where we're not just talking about stabilizing people, but we're also talking about stabilizing places, stabilizing neighborhoods, stabilizing communities. I, many years ago, worked at Shore Bank, very place-based institutions. And the idea was that Shore Bank was an institution that believed in the community and by being there was sending positive signals to others that it was safe to invest, safe to engage, safe to locate there. And I'd never really thought about that as it related to Opportune until now. I had really thought more about your locations as being really customer centric, like being where the customer is. I'm curious, in this time of COVID and also, civil and social unrest in community, are you thinking differently now about the role that your physical locations play and that Opportune plays as it relates to stabilizing not just your customers, but the communities they live in?
Absolutely. Yeah, we spent a lot of time thinking about this. Four things come to mind. Number one, just the ability to capital, right? Going back to everything we've talked about. And I'll be brief because I know you've got other questions you want to get to, but we think that being in that place gives us an opportunity to provide more capital than if we were just online only. The second is jobs, right? There is something just very empowering, and there is a dignity to having work. So having those 342 locations means that we're able to employ over 1,000 people in low and moderate income communities, and not just give them jobs, but give them careers. And that's also been something that we've been very focused on at this time. And this goes back to short-term versus long-term and stakeholder capitalism as opposed to just your shareholders. We have not laid off a person, nor have we furloughed anyone, because we think in this difficult time, right, to cut back people's income would weaken the community as opposed to allowing them to be at a good place mentally and provide for their families by having their jobs. So we think that providing jobs is a key part of being in that place, to your point, Jen. The third is we're really we've been talking about this for some time, but we've got a lot more clarity now. We're going to try to turn our locations into community centers. We have always sought to strengthen the ecosystem in the communities that we serve, because nonprofits, for example, do phenomenal work, and they do so many things better than we do. And we've always sought to partner with them. But what's become really clear is because we were able to keep our locations open, we can become a platform for being able to identify and serve a lot of individuals that need more help than what we can provide. But a lot of nonprofits weren't able to keep their locations open. So they've had to try to figure out virtually how to help people. And that's created some challenges. So we think we can help that way. And then finally, I think because we talked about this years ago, we think that our mission-driven for-profit model that in many ways, I think, combines the heart of a nonprofit with the sensibility that a lot of us have learned in our careers, can serve as a model potentially for how to really tackle difficult social issues. For us, it's access to capital. we're seeing right now is we're seeing a lot of the other challenges that we have as a society are really being laid bare, and we can all see them. And we hope that we can demonstrate a different and more scalable approach to dealing with some of those issues.
I can't think of a better place to end the conversation. Raul Vasquez, thank you so much for joining us today.
Thank you so much for the opportunity. Nice talking to you, Jennifer.
Same.
Welcome to this session. We understand you're coming from hearing Jennifer Tescher and others speak, so we know we have a tough act to follow. My name is Lisa Servan. I'm a professor of city planning at the University of Pennsylvania, and I do a lot of research on consumer financial services. I'm thrilled to be here today, although a little bit sad that we're not in person. Some of the best times at the Emerge conference are talking to other people in the hallways and exchanging ideas, but we're hoping we can get a good conversation going with you all today. And I know you've been invited to add some, send in your equity, access, and closing the aid gap. Long before COVID-19, low-income communities and communities of color had insufficient access to safe and affordable financial services. They also had insufficient access to money, period. That situation has been exacerbated by the global pandemic. Our audience, you have the bios, so I'll just do a brief intro and then ask you to respond, you on the panel, to the following question to kick us off. First, we have Marla Blow, who is Senior VP at MasterCard's Center for Inclusive Growth. Daniel Gorfine is also here. He is the founder and CEO of Gattaca Horizons LLC and an adjunct professor at Georgetown Law. And Dan Henry is president and CEO of Green Dot. So I'm going to start with one question that I'll kind of throw out to the whole panel, and then we'll get going. So here it is. The breakdowns in the system of getting aid to the people who need it most illuminates problems that we clearly need to address. What, in your opinion, is the most important thing we need to do to move the needle in terms of creating greater equity? I'm going to throw it out to you first, Marla, to get us going.
Sure, happy to. Thank you, Lisa. And thank you all. Great to be here at Emerge in this new format. And I share Lisa's sentiment on I have enjoyed having Emerge in person, but excited to be here in this structure as well. In terms of the distribution of aid and being able to reach people, we certainly have revealed the fact that we don't have structures that are set up for distributions writ large across the population by our government, and trying to turn the IRS platform into a way to distribute capital or distribute access to funds through a system that was never designed for it has revealed some real flaws. I'm encouraged by some of what I've seen on addressing, and at the center we think a lot about who's on the margins, and thinking beyond kind of the traditional bank accounts where the majority of people can be reached. But there are people for whom identity and and the ability to go and transact is limited. And so finding ways to reach them by some of the novel approaches I've seen on creating card products that are themselves a form of identification, so that for people who are potentially homeless and having an address is a challenge, or some other part of their citizenship structure causes challenges for them. Not having banks in your neighborhood causes challenges, right? All of those factors made the part of the population that wasn't directly reachable a little bit larger, I think, than a lot of us expected. And so I'm encouraged by seeing things like one of the products in MasterCard's portfolio that's been enabled by some of the cities and working with some mayors around the country to enable both identification and transaction capability on a single form and on a single device, so that, for example, in Los Angeles, large parts of the population that are homeless were able to receive a grant from a program and a sort of grassroots effort in Los Angeles to enable them to receive those dollars. So there are some ways that some of our current products are being adapted that can serve multiple purposes and enable broader reach by those.
Awesome, thank you. Daniel, do you want to go next?
Sure. No, thank you. And it's great to join all of you virtually. And I'm going to pick up, I think, where Marla was leaving off there. I mean, I'll talk a little bit in a second about central bank digital currencies. But before I even get there, I do want to double down on this concept of identity. I mean, I think during the crisis, there was a lot of talk about, the difficulty of getting emergency relief and funding to or underbanked individuals. Honestly, I think the reality and one of the biggest problems there was the identity issue. I mean, a lot of payment rails are capable of delivering funds. It's just a matter of, can we identify who's on the other end of that? And so it's been an area actually that I've been starting to look at a little bit more closely. And you start thinking like, we've got biometric information. We've got the ability to unlock, smartphones with our face. We can use fingerprints. Why not start thinking about ways that you can access government data, government information held in databases, DMV information, for example. If you sync that up through an API build, like, you should be able to start developing tools that would make it easier to onboard individuals, especially those that are trying to get kind of fast access to emergency relief. None of this, and I'm going to come back to this point many times, none of this is a panacea. And of course, there are going to be certain populations that it may not work for, but I think we have to take this from a few different angles. To that end, let me talk a little bit about CBDC, or central bank digital currency. I'm one of the co-founders of something called the Digital Dollar Project, which is a not-for-profit effort focused on exploring the potential tokenization of the US dollar. So to explain what I mean by that, this would be something that has to be run by the Federal Reserve or the government. But the idea is to allow people to use kind of digital cash in a digital world the same way you can use physical cash in the physical world. So while someone can go to an ATM machine and withdraw physical cash, the idea here would be the ability to actually withdraw a tokenized representation of a central bank liability. So the Fed actually issuing cash in a tokenized format. The way we've thought about this in terms of a champion model is that we would suggest running this largely through the two-tiered banking system. So you'd still rely on banks and other kind of financial technology intermediaries that may be regulated as money transmitters as one of the on-ramps to the system. But many of you may be then saying, well, I don't get it. How does that help with access and inclusion? Because obviously, if you're going through a lot of the traditional intermediaries, that may not be an immediate solve. So I think just to throw this out there, here's the hypothesis. Tokenizing the dollar just overall could create a lower cost system, less friction, more efficiency, and just lower overall costs of operation. Then at the end of all of this, an individual would have a digital wallet service essentially on a smartphone. And the hypothesis that we would love to test out is it true that a digital wallet service provider is a lower cost, more efficient and easier from an operational, technology, and from a regulatory perspective? Is this something that can be offered in a lower cost way than a traditional bank account? Is it more economically viable? If so, the ubiquity of smartphones makes this something that could come preloaded. People might be able to purchase smartphones and have options of digital wallet service providers, maybe married up with this digital identity component. And then you may be able to bring a significant number of currently un or underbanked individuals into the system. I was looking at, and I'll stop in a second, but I was looking at one recent data point from Pew that about 60% of the unbanked have smartphones. And they noted that the inability to load cash onto a smartphone is a significant barrier. So I, for one, would like to pilot and test the idea that this type of a system where you're tokenizing the US dollar and offering a more ubiquitous digital wallet service may be able to help with aspects of inclusion and access.
Super interesting. I have tons of follow-up, but I want to get Dan Henry into the conversation.
Thanks, Lisa, and thanks for having me here. And Daniel, I think what you're saying, a lot of that is absolutely kind of spot on and right in line with a lot of the thinking that we're doing here at Green Dot in terms of, how do you make, you talk about access and inclusion and affordability. Think of everything, so many things that have been digitized that have then driven the cost of those items to zero. Photos, for example, music, all of these things. And so I think that banking falls in the same way. And the more of it that we can digitize, the lower the cost will be. So if the piece of plastic as a form factor goes away, we may think, well, that's not a lot of money, that's $1, or it's a ton of money, because operationally to chase down a piece of plastic when lost or stolen, it's very expensive to support that on the back end. Dana, what you say about digitizing cash and currency, if you don't have to have armored cars and vaults and such to move this cash, that's a huge amount of cost that comes out of the system. I believe that but the biggest cost to banking and to payments, and we see it here at Green Dot, is fraud driven by identity. Identity theft, confirming someone's identity. And I'm very optimistic and just strongly believe in the evolution of technology in terms of when you take the capabilities that what blockchain creates in terms of being able to really grab someone's identity and protect that. You combine that with most everybody now has a computer in their pocket, and we go forward a couple more years and we've got 5G speeds to those devices. I really believe, Daniel, what you outlined in terms of solutions around identity protection will really show through. And I think it's absolutely critical because if you look at just what's happened with the CARES Act, there was a lot of aid. I mean, I really goes off to folks in DC. There was quick action, as quick as we can expect with the system government we have. There was meaningful dollars put into the system, but there was also meaningful dollars stolen in various pockets and states because of identity theft and systems that weren't, as tight as they could be.
It sounds to me like you all are really excited about technology and different ways of using technology to solve pieces of this problem. Since we're talking about equity and access today, and Daniel, you even alluded to, like, it might not, there's this chunk of people who have smartphones, still people who don't. Some of those people with smartphones might not be super comfortable with having that device be also their identification. I wonder if you could all address just the issue of, let's imagine that we were to kind of push forward a digital identity platform, made that much more accessible to a wide range of people. Who does it work best for, and who might still be left out? In other words, like what part of this gap that we're talking about would still perhaps face challenges and obstacles?
I'm happy to start. I mean, look, first of all, I want to make one point about all this, because as we talk about technology, yeah, there's great opportunity. But also we need to be very careful and make sure that we're thinking about the right guardrails. I mean, as I listened to myself at the beginning talking about government databases and APIs and DMV information and facial recognition, I'm sure a lot of people were like, whoa, let's be careful. And that's right. I mean, so I think, first of all, you have to think very hard about what kinds of systems you're creating. I mean, we don't want to develop something where you've got kind of super databases that just hold all of this information, because that is dangerous. I mean, just from a security perspective, you don't want to have the ultimate honeypot of identity information. So thinking about design and how you do this in a way that maybe you can ping and query, yes or no questions from government databases. Does individual, X's social security match with this information, yes or no? So you're not actually capturing and holding all of that privacy, that private or confidential information. I think that's important. So design is a big piece of this. Now, again, where I'm thinking about it, maybe solves for a certain percentage of the population. I do think DMVs seem very logical to me. I mean, we actually have, think about what we do in the physical world. We take driver's licenses and compare photographs, right? Like, we have technology that's getting better at doing that same type of a thing. So if someone's able to query, a photo database from a DMV and match to the real-time scan on a phone, that's interesting. It's not going to be a solve for everybody, because not everybody has a driver's license. So, I'm very much eyes wide open on that. I think we can think about additional tech sources to try to verify identity. I think that's important. Domestic is going to look very different than international. So if we're focused on domestic populations, that's one thing. When you start thinking about kind of the global unbanked, you're going to have very limited sources of information. But again, that's why I'm wary of anything that tries to be a one size fits all solution, because I don't think that's going to be the answer. It's going to be a multiple different good ideas that hopefully help chip away at the problem.
Yep. Can I build on that too, Lisa, and just add that one of the big challenges that goes along with this is the theory around access to the actual networks that power all of this, right? So having a smartphone and being in a geography where you have reliable quality access. And in a lot of cases, this is, the phone systems and the sort of wireless access is pretty solid. But when you start talking about rural parts of the country in the United States, even some of the neighborhoods within our major cities in this country, that can drop off. And if you're reliant on being able to transmit information back and forth in order to confirm your identity, in order to complete a transaction, you run the risk of that occasionally falling apart, right? And so as we think about technology creating access and creating equality in some respects, it also requires those underpinning systems to be really well established, and there are investments that we need to make as a nation, right, on extending broadband access to rural parts of the country. One of our grantees, the Center on Rural Innovation, has really highlighted the challenges of getting through this moment that we're in around shutdown for the pandemic. If you are in a rural community and you're trying to have this conversation that we're having right now via a virtual convening on a broadband access point, you can run into real problems. So this is obviously different from a transaction where you don't necessarily need to transmit as much information and have it be bidirectional in this same way. But the principle around ensuring that those systems are robust enough and equally distributed enough, I think, is also intrinsic to part of what you're saying, Daniel, on addressing some of this with these very powerful devices that we all walk around with and assume will be able to stand in for things like identity and exchange medium as a form of value exchange. There are assumptions underlying that are worth just pointing out. And that's why I wanted to add that here.
Thank you. Makes a lot of sense. Dan, do you have anything to add on this topic of equity?
No, let's move on to the next question. I think we've covered it quite well.
Okay. Well, I'm curious too about I'm thinking about when you think of identity, who gets to say what kind of identity gets used? I'm thinking about, I used to live in New York City, and or what kind of identity is acceptable. Marlon knows what I'm going to say, I think. When New York City created its ID card, it was one of the first cities that did that, because there are a lot of people who are immigrants who don't have driver's license, so it wanted to create this official ID. And the three largest banks didn't accept it as a valid form of ID, right? So that to me was a really unanticipated obstacle between people, and those people who didn't have driver's licenses were probably more likely to be unbanked or underbanked, not being able to use that form of ID. So just thinking even about the connection between identity kinds of documentation, and the ability to use financial products and services. Do you foresee technology being able to kind of fix that or ameliorate that? Or does that still give the corporate sector more power, right, in terms of deciding? And some might even have a little bit more of a sinister interpretation and think they didn't really want those customers anyway, right? But I won't go there.
So I'll jump in, and then I know Dan Henry wants to jump in on this one as well. I see you, Dan. One of the things that I think is coming, that I think is really interesting, is actually another form of identification, right? And another form of verification, which I expect will be some kind of health verification, right? So in order to go to a sporting event or a concert or to go to Emerge in some future years, we will all be potentially presenting some kind of verification of our health, right? Have we had COVID tests? Have we had it in the past? Are we potentially non-symptomatic carriers right now, right? All of those kinds of things. And how is that going to happen, right? And what will be the systems and the technology, and how interoperable will all of those be? So if I've done a test and I'm here in Maryland and Dan is out in California and Pasadena, are those going to be fungible? And how are we going to ensure that the same standards are being upheld, right? There's a whole new question about identity and about access and about who's going to be willing to accept somebody else's verification of health alongside the identity of my actual name and person. There is a status component of this that I think we will start to see getting added here as we all contemplate how we'll re-engage socially. And that has dramatic implications across a whole host of dimensions. So I wanted to just add that to the mix because I think it's an interesting consideration.
Yes, Marla, I think you make a real interesting point there. And I think as painful as COVID has been, I think it really has forced, it's probably caused 2 years of migration, in 2 months in terms of different approaches. I mean, just look at this, for example. I mean, pre-COVID, we'd all be in the same city having this conference. Okay. I don't know if I will ever go to a conference again. This is great. I mean, add to that, and investor conferences and so forth. This is, it's so much more convenient. But so Marley, to your point of, one thing I think we probably all agree on is the power of passion around our athletic events in this country. So I guarantee you, if we have to figure out a way to identify everybody and identify their health so that we can have the Super Bowl, someone's going to figure that out. And those solutions that someone figures out, entrepreneurs are going to be able to apply those, I believe, to a myriad of different sorts of solutions. Mm-hmm. And so, yeah, I'm always very optimistic of where it's going. And we just, for those, back when I used to travel 4 months ago, I always sped through the TSA line, with my 2 fingers with the clear solution. And 15 years ago, biometrics wasn't possible because the technology wasn't there. And so, there will always be a fringe amount of customers that have a hard time getting the access, be it from technology or be it from their physical location, what have you. But I believe that as we continue to drive to serve the masses, the cost of these solutions come down. When we really, really close the loophole on identity theft and fraud, the amount of money saved by the institutions in terms of fraud losses will be tremendous. And I think we'll free up a lot of funds that will make it to where we can kind of, in a way, we can cost justify serving a small percentage of the customers who we can't serve in our current new technology, if you will. But again, I'm overly and wildly optimistic that, what has happened to so many industries in terms of digitization and democratization is coming to financial services very fast.
So one thing, given that I'm a Washingtonian, I have to bring up like policy and regulation, of course, but just one thing I do want to throw out there that I think would be very helpful is the idea of putting forward, more safe harbor regimes and maybe even like identity passporting regimes. And I'll explain what I mean by that. So during this past crisis, we had the PPP program for Main Street small businesses. Many of the biggest banks, for a variety of reasons, ended up closing their doors to the program pretty early on. There are many Main Street small businesses that were customers of those big banks. Now, there were many other banks that had availability, but did not want to onboard new customers because of some of the concerns around KYC and fraud. And to me, it's kind of nuts that we don't have a system that says, if there's a financial institution that has performed a reasonable check and used reasonable standards, why can't we passport that KYC verification to another institution where they can rely on some kind of a safe harbor that says, if you reasonably rely on somebody else who took reasonable steps, you can onboard much faster with lower risk of liability there.
Dan, and think about the flip side of that. There is a thing called the Check Systems Database that says if you are a consumer that walked away from overdraft fees, your information's in that database. And all the banks subscribe to that, and before they give you a bank account, they check that database. So I'm just kind of I do find it ironic that, we have figured out a way to create a database of information to keep people out of the system. But, wouldn't it be great if we did what you're talking about and say, hey, Marla, I know you follow this procedure to get Daniel an account. And so therefore you follow the same systems and procedures and you issue to him, whatever, this ID passport that we all collectively agree is now valid. So he can walk into my institution and I can serve him without, giving him the 3-week, background check.
Right.
So what do you think, Daniel? You mentioned regulation. Is it just because the regulatory environment is so fragmented and it's hard to get anything done
I think that there are global regulators that have been looking at this. I think Singapore took a shot at a passporting identity regime a few years ago and actually quite impressively admitted that the first round didn't go very well, but that doesn't mean that they're done. And so they're talking about a 2.0 for that initiative. I think, my big picture takeaway from this crisis has a lot to do with the importance of digital infrastructure in general. I mean, it's what's allowed us to be productive and resilient. The fact that we can even do this right now is because of different components of digital infrastructure. And so I think now it's heightening how important some of these elements are. Like, there's no reason we don't build the interstates, if you will, that will allow people to do all kinds of things from an economic perspective, from a health perspective, via technology interfaces. I mean, I think that it makes a lot of sense. So, we'll see, but we'll see if there's more urgency behind this. I think it's difficult because liability is a huge concern. And don't get me wrong, I understand the importance of KYC and AML and the regulatory and law enforcement interests there. But you do need to kind of measure the costs of the current system versus the benefits and whether you're really solving for huge risk. I mean, again, I'm thinking if you've got a Main Street small business that's an existing customer of, Wells Fargo, how risky is that to be having some kind of a quick solution so that another bank that's capable of serving the customer, is able to pull information with some type of certainty around liability exposure? Like, I don't think that should be incredibly difficult, but then again, maybe I'm too optimistic for a Washingtonian.
So I'm going to pull in a question from one of a member of our audience that's come up that kind of relates to this, because as we're talking about technology and we're talking about closing the equity gap, the access gap, there's almost a presumption maybe that people do have equal access to technology. And someone mentioned earlier that, if you were trying to do this in a rural area or in other parts of the world, many of us, I know every day I take it for granted when I can just kind of come to my workstation and log on and be productive and connect with people. I'm wondering if, and this is the question, whether your companies are doing anything to address the digital divide. That is something I think that even to me, I used to study the digital divide, and I was surprised with the pandemic to see how many kids, for example, are not able to log into class to connect with their classrooms and their teachers or get the materials they need. They don't have computers, they don't have broadband. So that's another issue I think that's come to the surface. Are your companies thinking about that and doing anything explicitly to address the digital divide in order to make these technologies work better for everyone?
So I'm well positioned around that, obviously, right? MasterCard has committed to the Center for Inclusive Growth and did so 2.5 years ago, really. And so we're pretty far down the path of thinking about what makes the digital economy work for everyone, everywhere, and what are the missing pieces that are dependent on where you happen to be. So that's about place and the economics of place and the infrastructure around place. And so while we are obviously not a telecom company, we do have the ability to engage and partner with other organizations that are actively engaged at the forefront of trying to solve for things like broadband access and all about access to all of the networks that power the modern economy, right? And if you think about the networks we're talking about physical and infrastructure type networks right now around broadband, but there's also virtual networks and the technologies and some of the solutions that we've been talking about here. Some of the concepts that Daniel was throwing around about all currencies and crypto and some of the opportunities to develop new systems and new networks. Those are all about networks, and the value of it is the distribution and the breadth of that network. And ultimately, that also suggests social networks play a role here as well.
Yeah, absolutely.
And thinking about how to get more people attached to all of those networks is very much part and parcel of what we've done at the center and how we've allocated our philanthropic dollars, how we've allocated our talent and our time of MasterCard's people, where we do enable volunteer work, and in part in places where we've contributed MasterCard's actual products and technology in order to facilitate the development of these kinds of networks and the broader proliferation of the access of the kind of hooks that enable bringing more and more people into what we're describing as kind of shared prosperity, right? So we are, I'm in the philanthropic arm of the organization. Mm-hmm. The commercial side does work on this as well, but it certainly is front and center for the work that I'm doing right now.
Yeah, and I might add in terms of Green Dot, we're not putting up towers and building digital highways, but what we recognize is that utopia would be, as Daniel describes, we've all got rock solid digital ID and all currency is digital. Well, that's that would be great, but that's not reality. So we have Green Dot's money processing network, where over 100,000 locations in the country, Family Dollar, Dollar General, CVS, Walgreens, Walmart. So if you think about the communities where all Americans live and work, and to your point, Daniel, the ability to put cash into the network.
Exactly.
So if I'm a working individual and I get paid in cash, or most of my income is in cash, but I want to play in the digital world, how do I make that transition? And so for us at Green Dot, what we feel is a critical role for us is, if you will, kind of making sure that the old world, we own a bank, we have all these 100,000 points of location where consumers can actually bank and move cash into these digital solutions and serve the digital solutions that we believe are coming from lots of large partners here in the U.S.
Thank you. This is a little bit of a shift back to our earlier conversation, but I want to get another question in from a listener or participant who asked about developing countries that have implemented digitized cash through mobile phones and why that's not doable or happening so much in the US. Is there anyone who feels like addressing that question? Yeah.
So my first company, Euronet, gave me the exposure to international markets, and we were all across Central Europe, India, and Asia. And the listener might be referring to the solution out of Africa. Net, it's all, to me, it's all about legacy infrastructure. Okay? So when I first moved over to Central Europe, land-based lines were hard to come by. Well, cellular towers came and everybody had a cell phone, and they leapfrogged land-based telco. So when you jump into a country that has no existing banking system infrastructure that people are trying to protect, or that's what's utilized, and the technology drops into a greenfield place, well, yes, then the acceleration is quite dramatic.
Mm-hmm.
Yeah, I think that's right. I think what Dan's talking about is a forcing mechanism, right? What is the driver or the thing that creates the impetus, right, to get people to adapt and adopt, right, some kind of a new alternative mechanism for this. And one of the things that has been proposed alongside, I think what Dan is saying about what's the incumbent baseline, is also, for example, concerns about currency itself, right? So we've seen in some instances in various countries where there have been all of a sudden massive controls or restrictions placed on currency. Those are the kinds of things that will drive the adoption of something along the lines of what Daniel has suggested here, right? Some crypto, et cetera. So it feels easy to think that we won't move in the direction of crypto because we can't really see the rationale for it until all of a sudden there's a massive rationale for it, right? And it's often driven by some kind of either the absence of an infrastructure or a shock, exactly, like some kind of macro shock that happens, or some kind of design shock that happens into the system that will drive a new behavior getting learned quite rapidly.
And the only thing I would add on this is, we're talking about electronic cash or e-cash. I think Dan, you're referring to M-Pesa in Kenya. But look, I would say that we do have some of that in the US. And here's the big distinction, though. It's accounts-based systems, and they can be incredibly useful. So Venmo is kind of an accounts-based electronic cash type system. What I am getting at, though, and Marla, you're just talking about this, is that there is a distinction, though, between an accounts-based system and a true tokenized system. So accounts-based has pros and cons, but you've got certain counterparty risks there. The cash, the money is not money from the central bank, right? So you have a counterparty that's responsible for that money. When you talk about tokenization, I mean, you are literally talking about a central bank liability. It's like a banknote that says this is backed by the full faith and credit of the United States, and you're tokenizing that instrument so you can use it as you would cash, but in a digital context. So I don't think we really have seen that internationally yet. Certainly, we've seen some pretty interesting examples and applications of accounts-based systems.
That is super interesting. Thank you. I just got a note that we have 1 minute left. So I'm wondering if there is any final thoughts that you all want to share. Okay, I'm going to just say quickly, one of the questions I didn't get a chance to ask was just about how you're getting your information in terms of from your users. Again, this is not, you don't have a whole lot of time to answer this, but whether you're actually talking to people on the ground. Interviews, focus groups, folks who are really connecting to figure out what those bottlenecks are, because it's so tempting, I think, in this space to think about the technologies, the systems up here.
Lisa, you kind of hit a nerve with me. I mean, I've only been at Green Dot now for 3 months, but I can remember my days, and I asked that same question of a very well-known consumer advocate, and the consumer advocate said, well, we can't afford to do focus groups. And it just infuriated me because we do focus groups. We talk to our customers.
Or not to, right?
Walk in their shoes. And so I do think that we can really so easily get stuck in this thinking of like, well, this is the way it should be, but we
Yeah.
don't really know how it really is. So yes, at Green Dot, we will be spending much more time walking in the shoes of our customers to understand what problems we really need to solve for them.
That's a great note to end on. And next time we're all in person at Emerge, I totally recommend that folks do. I'm blanking on the name of it, but they have this exercise where you actually take a $20 check and you go out to a neighborhood and you have to cash that check and buy some things and use alternative financial services and really experience what it's like to be on the margins of the consumer financial services system. Let me thank all of you for being here. It's been a great conversation. And thanks to the folks at Emerge for putting us all together. It was really fun.
Thank you.
Thank you, everyone.
Hi, my name is Atticus LeBlanc, and I am the founder and CEO of PadSplit, where we are changing the world one room at a time. We do that by leveraging housing as a vehicle for financial independence. And we think if you're going to talk about community stabilization, since housing is the biggest single expenditure of any household budget, that it should be at the center of any community stabilization or financial stabilization program. Now, when we say leveraging housing as a vehicle for financial independence, what exactly does that mean? Really what it means is that we move strangers in together to make housing more affordable for them. And why is that important? It's important because we have a shortage today of 12 million affordable units in the United States. And unfortunately, we're losing more every year than we're creating. And so we continue to dig that hole deeper and deeper. And new affordable housing creation takes a really long time and is really, really expensive. It's also a problem because in virtually every major metropolitan area in the United States, anyone that earns less than $35,000 a year can't afford any traditional housing option. Think of an apartment or home by themselves. They would have to share something in order to be able to afford one of those units. And it's also important because, as I mentioned, housing is just really slow and expensive to build. And on average, to subsidize affordable housing units through programs like the Low-Income Housing Tax Credit Program, the federal government and local governments are spending about $209,000 in capital subsidy on average just to create that one unit. And that often takes years and years to create a project, and you need a very specialized skill set as a developer of those types of units to be able to create them. It's been very successful, creating 3 million units over the last 30 years, but unfortunately, with a hole of 12 million, we can't afford to wait another 120 years to dig our way out of this one. So, how does PadSplit solve these problems? Well, first, we try to use space more efficiently. So, rather than thinking about creating new spaces, which obviously are very expensive to do, we think about the fact that we are using space more inefficiently than at any point in history. And we have more residential space available per person than at any point in history. As family size has been decreasing over the last 60 years, home size has been gradually increasing to the point where we are almost double the square footage of the average home today than we were 60 years ago. The way that PadSplit takes advantage of the space is, as you think about these homes, you have first and foremost, a number of empty, unused bedrooms. And so how do we incent those homeowners or housing providers to put new people into those bedrooms? Secondly, how do you capture the inefficient, underutilized spaces, a formal dining room, for instance, or a home office, particularly in properties with small families or in a rental unit where these spaces go unused and largely unfurnished in a very significant percentage of the time. The second thing that we think about is weekly all-inclusive billing. So we include all furniture, utilities, Wi-Fi, laundry. We even include health services. We include telemaintenance too, but telehealth services, because a huge portion of the low-income population doesn't have access to traditional healthcare options. As you think about what the status quo is, let me ask you, what do you think what is the day of the week of the first of the month, of either next month or any subsequent month? And I'm guessing that most of you don't have that answer on the tip of your tongue, even though the entire rental industry bets that low-income, vulnerable populations should have to juggle the 10 different living expense bills around that date, even though everyone acknowledges that they are typically living paycheck to paycheck. And that's a virtually impossible task for many of them. So instead, we think about how do we consolidate all these bills into a single payment and bill either weekly, because everybody knows what day of the week Friday is and when Friday is coming, or we consolidate those payments and bill according to their actual pay period. The next thing is really just thinking about aligning incentives between housing providers, the residents who need more affordable options, and the communities who want to be able to house their workforce and have better environmental outcomes and better traffic outcomes and better economic development outcomes for their communities. And if you think about traditional affordable housing programs, they're typically built around incentivizing housing creators as a percentage of costs. So it shouldn't be any surprise to anyone that those costs continue to increase, because if you are like virtually everyone else on the planet, you want better economic outcomes for yourselves as well. No surprise that developers do. And therefore, if you're paying someone as a percentage of cost, you are likely to see those costs increase. Whereas the way that we look at this issue is, how do we figure out how to make affordable housing possible by also making it profitable, and more profitable than some of the other subpar strategies that we see employed by housing creators today. So those strategies often lead to gentrification and displacement, and the building of McMansions in individual neighborhoods that don't create the same type of outcomes that we like to see. So how do we then give them an incentive to show them that they could make an equivalent amount of money or potentially more through an affordable housing model? And so we demonstrate for housing providers how to create these types of units that are more affordable and create a more holistic solution for these residents who are most in need. And right now, those residents, they make too much money to qualify for traditional public subsidy programs such as Section 8 or the Housing Choice Voucher Program, but not nearly enough to afford the traditional market rate options. And so their choices today are staying in extended stay motel, where a recent report in Georgia showed that 84% of occupants of extended stay motels lived there full time, and 22% had lived there for more than 3 years. Whereas if you approach that same group of people, who I'm sure would love to have permanent housing in apartments, but they don't have either the credit or the income history or the savings to be able to put down that deposit, or the credit to be able to qualify for one of those units. And so as we think about these problems and the way that PadSplit solves them, you may be asking yourself, well, what are the results of this initiative and this program since we started about 2.5 years ago? And to date, the community that we are serving averages an income of about $21,000 per year. So again, not quite enough for a single person to qualify for most subsidy programs, but not nearly enough to qualify for those affordable housing options. But even though those people are only making about $21,000 a year on average, we're creating savings opportunities by consolidating all those bills into one and creating savings overall, that they are seeing the ability to save almost $500 a month on average between housing, utility costs, and transportation savings. The other really interesting takeaway is that we haven't taken a single dollar in public subsidy to be able to create these units. We've facilitated the creation of over 930 units in the last 2 years, and the equivalent public subsidy that would be required to build those units, if we were going to build them new, is $194 million. And we've taken zero of that, and obviously been continuing to accelerate the rate of growth, not just in the Georgia area, but as we expand to new cities here in the coming months as well. And so to more intimately illustrate these results, as well as kind of the old way of creating affordable housing, or the traditional method, versus the way that we do it, I want to tell you 2 quick stories. The first is from a trip that I took to New Orleans about 3.5 years ago to tour a traditional low-income housing tax credit development, which, as I mentioned, has been a very successful project. I don't want to take anything away from it, but hasn't engaged in the same level of customer discovery that I think would behoove any investable startup. And as we toured this facility, it's a beautiful building, and it was an old school that had been restored and fortunately had been repurposed for affordable housing. But as we toured the building, one of the residents invited us into his apartment. And as we toured his apartment, first and foremost, it was a 750 square foot apartment for one individual. And so clearly not a super efficient use of that space. But the second thing that was most striking and frankly depressing was the fact that he had lived there for more than a month, but he was sleeping on the hardwood floor because he did not have a single piece of furniture except for one metal folding chair, which he had salvaged from a nearby property. And so I look at this project and I see that the federal government had invested $160,000, the state government $30,000, the local government $10,000, so $200,000 in capital subsidy plus an ongoing rental subsidy for this individual, and yet no one thought to include furniture in his living expense. And at the end of the day, I feel like that just goes to poor customer discovery and alignment with the needs of these individuals. And the second story is about a woman named Tiffany, who I've been close to for several years now, but was one of our first residents. And unfortunately, Tiffany moved to Atlanta from Alabama after some troubling family issues in Alabama. And she took a job as a night shift security guard for a film studio here. And like many people, her first stop was an extended stay motel so she could get her new start. Unfortunately, she was paying more than $1,200 every month for that room. And she was forced, because she worked the night shift, and this was not in a particularly safe area, she was dodging drug dealers and prostitutes in order to catch the bus on her way to work every evening. So she was desperate for a new place to stay. Fortunately, she found a pad split, and in her words, she had never stayed in a situation like this before, but this was the nicest house she had ever seen. And so I was certainly very grateful to hear that, but even more grateful to know that within the first month, because she was paying only $550 a month for this holistic living option, that she was saving over $600 every month. And so within 3 months, she was able to save enough for a used car. And 3 months after that, she was able to save enough for a deposit. And having built her credit, she was also able to get a security deposit for an apartment, and was able to move on and graduate from her pad split within a 6-month period. And that was at no cost to the federal government or any capital subsidy necessary. And so as I illustrate those stories, the point I would like to leave you with is really 3 things. One, that we have to find ways to use space more efficiently than we have previously. Second, that we have to do more customer discovery and really be proximate to those individuals that are most in need. And third, we have to build a housing continuum in every sense of the word, so that people who need a fresh start or have had some sort of traumatic event in their lives, or frankly just low income, have the ability to move from an extended stay motel or some level of functional homelessness where they may be living in their car or in a park or spending the night in an airport lobby. Because right now there's nothing that exists between that and the traditional housing options that we've always thought about, the apartments and the single family homes of the world. And that's really the space where Pat Split exists, so that there can be a continuum that people have the ability to move through in order to reach financial independence. And first, to build savings, second, to build income, and then eventually, hopefully, to build wealth over time as they move into home ownership positions. But thank you so much for listening, and really appreciate your time, and hope you enjoy the rest of the presentation. Thank you.
Our session today, Fintech and Nonprofits Partnering to Aid Vulnerable Communities. My name is Joshua Sledge. I'm a Senior Director at the Financial Health Network, and I am thrilled to be here with you today with a terrific panel of speakers. Around the horn, we've got Matthew Cooper, Co-Founder and CEO of EarnUp. We've got Kristen Holt, President and CEO of GreenPath Financial Wellness. Ronnie Washington, Founder and CEO at Onward Financial. And last but not least, Jimmy Chin, Founder and CEO of Propel. So our session today speaks directly to our theme around stabilizing communities. And particularly when we talk about underserved communities, we're almost by definition talking about communities that are marked by a lack of institutions that are willing to invest in them. So oftentimes it's nonprofit organizations that stand in the gap to be a source of trust, support, and guidance for vulnerable and struggling families. And recently we've seen nonprofits partnering with mission-focused fintech providers in ways that can really increase their impact on financial health and also raise the voice of their communities. At the Financial Health Network, we've been able to convene companies and organizations and provide some support to some of these emerging partnerships through our nonprofit Fintech Exchange, a program in our Financial Solutions Lab initiative supported by JP Morgan Chase and Prudential. And we believe that these types of nonprofit Fintech partnerships have a lot of potential because they play on complementary strengths. Nonprofit organizations are often reaching into the hardest to reach communities, building trusted relationships, and getting a deep understanding of the multiple needs of their clients and how they all overlap. At the same time, fintechs are creating new and innovative digital tools really designed to help people make the most of their financial health and the resources that they have. So partnerships can give nonprofits and their clients more tools to move the needle on their financial health. And at the same time, these kind of partnerships can give opportunities for nonprofits to inform how fintech is built so that it really meets the needs of all their clients. And as we see financial services moving ever faster toward being all things digital, these partnerships can be critical in making sure that products are inclusive. So our panelists today have been doing this work, and I'm really excited to hear from them about what they've learned. So without further ado, I'd love to turn it to them so they can introduce themselves. So Kristen, I'll turn it to you first. Tell us a little bit about yourself, GreenPath, and some of the work you and your organizations have been doing around nonprofit and fintech partnerships.
Well, thank you, Josh. So yes, I'm Kristen Holt. I'm CEO of GreenPath Financial Wellness, and we are a national nonprofit. We serve about 200,000 people a year over the phone through empathetic financial counseling and coaching. And we're known for our use of human-centered design and behavioral economics to meet clients' needs and help them achieve their financial goals and improve their financial resilience. We've been partnering with fintechs for about the past 5 years, and we're really grateful for this opportunity to share some of our learnings and examples. So I don't know about you, but now that it's summertime, I eat a lot of ice cream. And I thought ice cream might be an interesting way for me to just share some of the partnerships that we have done in different flavors, if you will. So the first is just your basic ice cream cone, where we've got 2 different flavors, and we really think about that as a partnership where we're cultivating. An example of this is GreenPath has partnered with the Association of Independent Workers, also called IPSI, and they are an independent association that helps people who are 1099 workers and maybe don't have access to insurance and different things like that. And so this really is more of a passive partnership, but they promote to their members our services for financial coaching and counseling. Certainly people have needed that a lot more, especially with COVID hitting. And then we also let people that we're working with know about IPSI and their services if they happen to be an independent worker. So it's really the simplest flavor of a partnership. Then as you move down the scale, we can think about an ice cream sundae where we're really collaborating to create something new together. And an example of that is our partnership with a company called Asset Health to create the Healthy Sense platform. This is a digital financial wellness platform for employers that they can make available to their employees. And Asset Health already had a platform for physical and mental health, but they wanted to build one for financial health. And so they worked with us, and using our human-centered design and behavioral economics expertise and our content around financial wellness to create an engaging user experience and content. And today we've had about 6,000 employees who've gone through the different assessments on the platform. So that's an example of really collaborating. And then last is the banana split, if you will, and the cherry and whipped cream on top with one of my partners here on the panel with Matthew, and that's with EarnUp. So we've been collaborating with EarnUp for several years now, and we have a fully integrated system. Together, we created the Simple Payment Plan. So at GreenPath, many of our customers go on a debt management plan to handle their unsecured debts. And we didn't have a great solution for people for secured debts like a mortgage or student loans or auto payments. And so by working with EarnUp, we were able to give people a one-stop shop, if you will, to handle all of their debts in one place and really manage it against their cash flow. So instead of having one big payment due at the beginning of the month, they're able to spread that out over their whenever they get paid, and they're able to accelerate the pay down of their debt. So those are really 3 different examples of how we have partnered with fintech.
Fantastic. Thank you, Kristen. Now you got us all thinking about ice cream, and
yep,
it's not such a bad thing. But I'll turn it now to Matthew, given the 2 of you have worked together. Matthew, would you like to tell us a little bit about EarnUp and some of the work you've been doing in partnerships with nonprofits?
Yeah, I would be happy to. So thank you, everyone, for being here today, spend time on these important topics. So EarnUp is a award-winning consumer platform that intelligently automates loan payments for the 200 million indebted Americans. And our goal is really to make it as easy as possible for consumers to stay on track for their payments and get out of debt faster. And we do that through sort of a highly personalized payment and financial sort of health platform that we try to automate everything we can for the customer. So get them out of decision-making and allow sort of payments and improvements to their financial life to happen sort of automatically. We have about over $10 billion in loans that we manage on the platform right now for consumers of all types. And we partner with a variety of like nonprofits, government-sponsored entities, and corporations to distribute our product and make it better. That includes people like Freddie Mac and Bank of America, and also includes a range of nonprofits like GreenPath, which I'll talk about a little more in a second. We are very fortunate and humbled to have gotten a number of sort of accolades for the work we do with paycheck to paycheck consumers, and that includes being part of the Financial Solutions Lab, which was an incredible experience for us, and this community continues to be a very supportive one, and one that helps us stay sort of true to our mission-driven orientation. On the nonprofit side, so we've worked with a variety of nonprofits over the years, starting with a number of years ago when we started the company. Our longest standing partnership has been in the nonprofit space, has been with GreenPath Financial Health. And whereas Kristen mentioned, we have sort of co-built the Simple Payment Plan, which helps these high-risk consumers stay on track for their loans and get out of debt faster. And that has been a very successful program for us. And I think all the data would suggest for the customers. You know, we have helped Americans make over $8 million in loan payments on that program, many of them accelerating loans for the first time. And accelerating being that they're making not just their bare minimum payments, but extra payments for the first time on their loans or sometimes in their lives. And that is an incredibly powerful thing to see. Qualitatively, we just get a lot of feedback that there's also just this emotional release of going from stress and feeling overwhelmed to just feeling like, okay, I have this covered. And you know that where we found, you know, GreenPath, yeah, there's a lot of novel insights. Maybe some of those will come out later. I won't go into those now, but we continue to deepen the relationship with GreenPath on the nonprofit side. So we have just launched sort of a new pioneering program focused on helping LMI communities get into homes for the first time. The details of which will be sort of emerging, but it is live and active, and it's incredibly exciting to see that we can sort of take entirely new, almost co-develop entirely new products to solve problems that are sort of structural and ingrained. The last piece I'll just mention on the nonprofit side is that as the COVID-related recession and hardship hit these paycheck to paycheck communities, which we serve very hard, we have relied in new ways on our nonprofit partners. Certainly with GreenPath and a few other, that was another example where we really were just information sharing, what's happening, what are people doing? Are they budgeting? Are they saving? Are they in chaos? So getting that kind of information, especially from GreenPath, because they have a phone-based model where they're talking to all these people, and we have a lot of automated model. So we don't get the richness that GreenPath gets right out of the customer base. So that was a space where we were able to collaborate to figure out how can we respond. And we also put an appeal out. We have a number of impact-oriented investors that are themselves nonprofits, people like Acumen Foundation, K4 Foundation, et cetera. And we went to them and said, we want to provide money to the hardest hit people in our communities that we are serving on the EarnUp platform. And a number of them supported us actually in applying for our grant, which we have received, but we haven't publicized yet. It's fairly sizable that we're going to be able to basically target those funds to super high risk kind of communities that are hard hit and provide sort of an auditable kind of financial trail for that information, which is something that's very hard for a lot of these grant makers to do because we are the payment entity. So that's another space. We don't know anything about grant making, but we were able to leverage the nonprofits we have relationships with to help us kind of do something together we couldn't do alone.
Fantastic, fantastic. Thank you, Matthew. And Jimmy, I want to turn to you next, given I know you and the team at Propel have really been doing some very exciting things on this front recently.
Yeah, thank you, Josh. So I run a fintech startup based in Brooklyn that builds software for people who receive SNAP benefits. SNAP is also known as the food stamp program used by about 40 million Americans across the country each month. And when I set out to start Propel, one of the things I realized is that those 40 million people get their benefits on an EBT card, which looks like a debit card. It has the funny quirk of needing to call the 1-800 number on the back of the card so you can check your balance. And so everyone who has an EBT card calls this phone number all the time to know how much they have left on their cards. We built was essentially a mobile banking app for the EBT card to replace that 1-800 number with a digital experience that is similar to what you would expect from a modern financial services platform. That is the Fresh EBT app. We launched that app about 4.5 years ago, and it's continued to grow ever since. It serves about 3 million Americans throughout the country now who use it at least once a month to manage their SNAP benefits. The average consumer we serve is a young mom who lives in a city. So about 85% of our users are female. About 90% have a child under the age of 18, and the majority live in cities. The work that we have always done at Propel is in a sector that is traditionally served by nonprofits and governments. And so we have had a number of different types of partnerships over the years to both learn from those organizations about the best way that we can serve these consumers. We are building a trusted, commonly used product and service that has a touch point on a daily or weekly basis with these consumers. And so we feel the opportunity and sort of the responsibility to learn from the people who have spent their whole careers working with this consumer base to figure out what that relationship ought to be. A few examples of the types of partnerships that we've had, and to Josh's point about the types of work we've tried to do during COVID. One example of this is a program that we recently rolled out called Project 100. Which is addressing a similar type of challenge that Matthew was touching on, which is that a lot of low-income families have been hardest hit by COVID. and as a result are just having a lot of trouble making basic needs, kind of making it to the next month in terms of paying rent and paying bills and so on. So we partnered with a nonprofit to provide cash grants directly to people who use our Fresh EBT app. Our particular role is that because we are plugging into these various state systems to get a sense of what someone's EBT information is, that we can validate that this is someone who's in financial need. And the nonprofit is the actual organization that is providing the grant and actually transferring the capital to the consumer. So Project 100 is an effort to raise $100 million to serve 100,000 people who are struggling financially because of COVID. We've done a variety of other types of partnerships to use Fresh EBT as a distribution platform, because we do have that relationship with low-income consumers across the country. Partnerships include the Financial Clinic, which offers a variety of financial coaching through us. The Saver Life platform offers a savings incentive. And broadly speaking, I think, we think that there are just so many organizations out there that are providing fantastic services for low-income families. And if we can be a trusted channel to help them to learn about those services and to enroll in them, then that is a true win-win.
Fantastic. Thanks, Jimmy. And yeah, the Project 100, I think, is such a great example of, again, leveraging the complementary strengths and capabilities to really create a pretty powerful solution. And Ronnie, tell us a little bit more about your work at Onward, and you really kind of come at this nonprofit fintech question in a really interesting way.
Yes, thank you so much for having me. My name is Ronnie Washington. I'm the founder and CEO of Onward Financial, and we do sit in a fairly unique position as a fintech nonprofit, so seeing both sides of the coin. Our mission is such that we provide the tools for every worker to build a financial cushion. And in doing so, we partner with employers, particularly those that are in the small to medium-sized business category, to serve their workforce, which often make up a large number of low to moderate income workers, typically those that are earning less than $20 per hour, that struggle to save and will often end up either utilizing pay advance services, payday loans, or other short-term cash alternatives. We essentially offer a platform to the employer to provide a customizable financial wellness solution to their workers. Everything from setting up the savings piece of it to managing incentive campaigns, to also customizing how they want to deliver those incentives based on rewards or ongoing incentives and so forth. For the employee, we provide payroll linked savings. So you can think of it as what the 401k does for for retirement savings, Onward does for emergency savings, just making it very easy for a worker to get started, set it, and ultimately forget their savings until they really need it. On top of that, we provide education in bite-sized chunks, and specifically during the COVID-19 period that we're all in, resources and tools to navigate this time. And most recently, and something excited to share, I have partnered with Neighborhood Trust to offer coaching services, which is a nonprofit as well. We come into this work, like I said, in an interesting place of being both a fintech and a nonprofit. On the fintech side, we actually partnered with a banking as a service provider to do a deeper integration to offer an account, something that was out of sight, out of mind, just enough for people to be able to save and not tap into it for discretionary spending. While on the nonprofit side, I mentioned we partner with Neighborhood Trust to be able to offer coaching services that can help people address, especially in this moment of so much uncertainty, what do I do now? I am facing so much uncertainty. There are all these terms being thrown around at me, forbearance and other things that I don't quite understand or don't know how to navigate. What do I do now? So we'd be happy to talk about both the experience on the deep integration side, but also how we were able to identify auxiliary services that could benefit our user base, the employees, to address kind of what we're all going through right now with COVID-19.
Fantastic. Thanks, Ronnie. So I've got some questions for the panel, but if anyone else has additional questions to ask, feel free to use the chat box and we'll try to get to those as we can. Jimmy, I'd like to start with you. Right? We kind of talked about these nonprofit and fintech partnerships, the potential underneath them, but I'm wondering from your standpoint, where does that potential pay off? Where have you seen the real benefits of partnering with nonprofits and community organizations? And like on the other side, where have you seen some of the biggest challenges and difficulties in really kind of, going across sectors and partnering in new ways?
Well, I think the benefits are pretty clear to our users in the sense of, the types of services that a lot of nonprofits are experienced at offering are are exactly the kinds of things that a lot of low-income Americans need access to on a day-to-day basis to improve their financial health. And we actually partner with nonprofits across the spectrum, certainly with folks who work in financial services and on financial challenges, but also we partnered with, for example, a nonprofit that focuses on helping people to get incentives for eating healthy and for purchasing food at farmers markets. We've partnered with a nonprofit that helps our users to be counted through the census, and nonprofits that do voter registration. And so for us, I think we don't necessarily see nonprofit as a category per se, but our filter is more of like, what are the services that actually can help our user, someone who's low income using SNAP benefits, to improve some component of their lives. And it just so happens that a lot of those services are nonprofit. I'll say, Josh, I think on the challenge side, the biggest challenge for us has been geography. Because we are a technology company that serves users in all 50 states, generally speaking, it's challenging for us to do partnerships that don't have a similar type of scale. Now, we have built some infrastructure that allows us to partner with smaller nonprofits or nonprofits that are working kind of a state or regional basis. But that is like always kind of a challenge for us as a startup, as a small company that wants to work with every single organization that wants to use us as a distribution platform, but that has to sort of figure out how to make these numbers work.
Yeah, it's a really great point. What's the right fit for both the organization and companies to really make these kind of partnerships align and work for both of their purposes? That scale piece is something that we see often come up, and making sure there's good alignment there. Ronnie, I'm curious how you approach this question, almost as being both a fintech and a nonprofit. Where do you see some of the benefits and challenges of that kind of dual status?
Absolutely. I think the first thing that comes to mind is trust, especially when it comes to partnering with nonprofits. There's a certain level of inherent trust that's baked into, while it's a tax status, like this alignment with mission and putting that at the forefront definitely helps a lot in our conversations with employers, but also in the delivery of services to employees directly. So I think that's a huge benefit, and also that the alignment in terms of who we are serving. It can be tough sometimes with for-profits in some cases where they might serve a completely different customer base or a different segment of the market and are trying to move into a new segment to kind of align interests there, but also to get a general understanding of the unique needs of that segment. So I've been able to see kind of both sides of the coin here, but I think in general, finding that alignment, really anchoring on the trust piece of it and making sure that the segment that you, whether it be nonprofit or for-profit, are looking to serve are aligned with the overall outcomes that we're seeking in these partnerships.
Yeah, absolutely. I think that alignment piece is key. And Kristen and Matthew, I'm curious from your experience working together, what did you see as real key ingredients for getting that alignment and getting on the same page in terms of building something together? Kristen, I'll go to you first.
Okay, thanks. Well, I couldn't agree more with what Ronnie said around trust. And so that was something that I think was really helpful when we first started partnering with EarnUp, because our customers are reaching us usually from a trusted referral to start with. And then we were able to explain the EarnUp platform and tool and the simple payment plan in that trusted environment. So, people who are reaching out to us are navigating a really complex world of financial solutions and things. And so they knew when they worked with us and we're saying, hey, we've got this tool, the simple payment plan that can really help manage your secured debts, along with like a debt management plan, which would be our traditional product offering. It really helped just take out some of that concern that there might be with just finding a fintech directly.
Gotcha.
Yeah, I agree with all of that. I think I'll take the more analytical approach just in terms of structure, because I view all of our enterprise partnerships, include whether it's a bank or Freddie Mac or GreenPath, those are all partnerships to us, and most of them don't work. That's the short answer. And so I think that just a few of the things that I think make a partnership work in GreenPath has been a great illustration is like completely aligned or 95% aligned key incentives. So does what you want actually really align with what we want? And usually the answer is no in most partnerships. That's been my experience. And that has to be at every level that's required for success. So just in the case of GreenPath, let's start at, do the customer have a problem, right? Yes, and Kristen gave a little bit of detail about why, with their specific product experience they have today, why there was a pain point for secured debt. So there's a pain point there. There is also a pain point at the company level for new ways to support customers on a mission basis, but also new ways to generate revenue, right, that can support the entire operation. And that was also something we were excited about. So I think all of those things sort of need to align. The way we think about it internally is like, if our top KPI for the partnership isn't in the top 2 for the company that we're partnering with, it will fail. And usually it doesn't fail right away. It usually fails 3 to 6 months in when you're trying to integrate and there just isn't enough energy to complete that integration.
Yeah, I would just add, for us, we always we want it to be a win-win-win. So it's got to be a win for our client and solving something for the client, and then it has to be a win for the partner, and it has to be a win for us as well.
Fantastic. So we got a question from the audience. So what would you identify as some of the key issues that are facing low-income consumers in accessing relief measures? Cash assistance, those types of things that sounds like with Project 100. Jimmy, you're doing some work with. I know all of you across the board are really responding to your client needs. Any recommendations or kind of key issues that you've seen in trying to respond with that kind of direct assistance? Jimmy, I'll go to you first if you have any insights from Project 100.
Yeah, I guess I'll start with the obvious one and the one that's been covered in the media, which is that I think for the tens of millions of Americans who don't have a strong banking relationship, accessing relief funds like the stimulus payment has been exceptionally challenging. And I think there are lots of organizations out there, whether fintech or nonprofit, who are putting various solutions into play to try to address that. To me, it's just sort of an example of like, I think people generally talk about how the unbanked or underbanked in the United States, it's like a societal challenge that we ought to solve. But I think that infrastructure is laid bare when Treasury needs to send out money over the course of a few weeks, and now we're talking about sending paper checks because we don't have the right infrastructure. So that's number one. I'll say from our perspective at Propel and through the Give Directly partnership, which is Project 100. One of the other issues that we are dealing with is fatigue, which is the perspective of like the need, the financial need that low-income Americans face is ongoing. And I think, we see this in the unemployment numbers and the kind of macroeconomic things that people are saying about what the economy is doing. But the reality is a lot of our users are not any better off now than they were right when this crisis started. In some cases, they are worse off. So a lot of these measures of food insecurity, of instability in housing, of challenges with health and savings and credit, all those things, these tend to be getting worse over time. And so, there's sort of this question of like, who is going to step up to fill this gap? And it's not going to be any one player, right? It's certainly not going to be a single for-profit. It's probably not going to be a single nonprofit. It's probably not going to be just the public sector, but sort of how do these players all come together to help to bridge low-income Americans through a really unprecedented financial challenge?
Mm-hmm. Yeah, and Kristen, I'm curious from your vantage point at GreenPath and some of the interactions that clients have been calling in and engaging with staff here. Are there any key challenges or common issues in the same front that you've seen people facing as they try to navigate their way through the crisis?
Yeah, I think one of the basic things is just the level of stress that people are under. And so when they're reaching out to us, and they may have been trying to reach out to lots of different places and people weren't answering the phones in the beginning. So when they're finally getting a hold of a live human, they're very much in this place of scarcity and this scarcity mindset. And so, when you're under a scarcity mindset, that it's very hard to process things. And there was so much information coming at people. And so I think what we really found is that people found it very helpful to just be able to connect to a human and have someone who could listen to them and understand their situation, and then very clearly help them understand the benefits that might be available to them and how to access those. But that challenge of stress just really has affected everybody. And it's very difficult to navigate.
Absolutely. Matthew, I'm curious, we talked at the outset about this opportunity to really take the experience of these types of partnerships and use it to inform product design, to ensure that the kind of products you're offering are inclusive and really speaking to the needs, preferences, capabilities of particularly underserved communities. I'm wondering if you've had any aha moments, things through these partnerships where you learned that maybe a product needs to be tweaked a different way, or we need to engage the clients in a different way. Anything that you've learned from the experience of working with via these partnerships that's really informed your product design?
Yeah, I mean, I think just using an example of the GreenPath partnership, working with GreenPath has been, especially since we started partnering very early in our product development experience, has created probably, 30% of what we've built has been somehow influenced, by that partnership. So to give an example or two, one that has come to mind for me is our core partnerships often with banks are in the mortgage space. And one of the things that's been really exciting and different is to see that through GreenPath, actually the largest number of loans, the ratio is with student loans. So just as kind of like a aha for us, it was just like, oh, there is actually a lot of demand outside of the core mortgage vertical. And that influenced basically how we thought about the core product design, because if this isn't just a mortgage app, I think GreenPath also got us on to the fact that, these customers wanted to put insurance on this product and like a bunch of other bill payments that we just really didn't think were of interest for a variety of reasons. Those are poor hypotheses. So I would say that's a pretty fundamental hypothesis for us, which is which types of loans and bills do we want to support? And are we designing a user experience around a single payment, like a mortgage, or are we designing it? So that I would say that's one space that we've seen pretty big ahas. I think another aha, which is one step in the middle of the product, is I think how you distribute a product. We've learned a huge amount. How to and not to distribute a product. We've learned a lot about the GreenPath partnership, especially early on. And I think one of the learnings there that is that I think we forgot about a key customer as we thought about kind of customer first design, which I think GreenPath is been a real leader in, and it helped us learn a lot about. And so we had sort of the win at the GreenPath EarnUp corporate levels, organizational levels, and we had the consumer piece, but there's another key customer, which is the phone agent who has to basically distribute the product. And I think just from EarnUp's perspective, I think we massively devalued that. We kind of assumed, well, GreenPath will say something and then it will magically happen because Kristen's excited. And that's just not how it worked out early on. There were all the best intentions, but we only really started to see material traction when we got into the intricacies and intimacies of like, what is this consumer experience of the agent? What information do they have? What information do they have to collect? Can we automate that as much as possible? So I think that was another big learning, which again, GreenPath is such a strong focus on customer experience. It kind of educated us, in a painful way that no, it's not just about management saying, go give EarnUp away. It's a good thing to do. There's a lot more to get into the heart and soul and the mechanics of who's actually distributing the product in an offline environment. And we still use offline distribution, offline being like phone-based or in person, for a good portion of the partnerships we work with. But this was really the first time we got to see that in action.
Yeah, no, that's really interesting. It's something we've seen as well, that I think the insights and enthusiasm of frontline staff at nonprofit organizations, the people that are really working in communities and have developed that trust and a real sense for what their clients need, has been gold, I think, for creating the types of partnerships and products and services that are really going to meet the needs. Oftentimes, they almost serve as gatekeepers. We've seen that they are going to want to make sure that product is a good fit before they offer it to the people they're working with, and that's a really helpful point of feedback. Ronnie, we had a question for you from the audience about the partnership with some of the banks you're working with to offer the savings accounts for employees. Can you just talk to us a little bit more about kind of how you set up that partnership?
Sure. So we fundamentally believe that a separate account, like I said, that was out of sight, out of mind, was a really important feature. Similar to like what a 401k does. People don't check it every single day. At least I know I haven't. But it's something that just builds over time. So after we were able to test that theory at a very small level with the actual local credit union in Kansas City, we thought about how would we deliver this on a national basis. So looking at the landscape in the ecosystem of banking as a service providers, we were able to find one that really aligned with what we wanted to accomplish in terms of generating savings for this segment. Folks that may be saving $10, $20 per pay period, but that's a significant amount to them to start with. So right now we partner with Evolve Bank and Trust, which basically allows us to have a savings account at an FDIC insured bank that people can access through our application, as well as withdraw from, which is liquid, especially during now, like being able to access those emergency funds becomes really critical. So it did take some testing and learning in the first few years of the organization's life, but then we've been lucky enough to be able to find a partner that was willing to accept these deposits, but also work with us with the type of clients that we're serving.
Fantastic. Again, it seems like that partner alignment, finding the right institution to understand who you're serving and really be on board to do that.
Absolutely.
Sounds really important. We had another question, Jimmy, around the translation of FreshEBT into Spanish. And I think it's actually notable that a lot of fintechs that we've seen in the marketplace haven't had that kind of translation. As we speak about and talk about different communities that we're serving, I'm wondering if you could talk to us a little bit about just how you made those kind of adaptations to make sure you're talking to different communities, whether you're planning on doing more on that translation front, or really how you've seen that move resonate with your customers.
So SNAP participants in the United States, I mentioned there's 40 million individuals. They are not a monolith, right? You've got people from all different walks of life, all different cultures, speak different languages, and so on. So FreshEBT is translated into Spanish. That's the only other language besides English that we offer, and we very much intend to offer it in more languages in the future. The challenge is essentially an operational and technical one, which is that if we decide to translate the app into Spanish, then every subsequent piece of content or new feature that we roll out has to also be translated into Spanish. We are fortunate to have a Spanish speaker on staff who is actually the 6th employee at the company. And so she has sort of been the standard bearer for making sure that FreshEBT works for people who speak Spanish. And so that has been an incredibly, it was the right decision for us to make. Currently, about 20% of FreshEBT users are using the app in Spanish. And so that is a very sizable, portion of our user base that is currently doing that. I think we've run into this a handful of times where we've spoken to different potential partner nonprofits who would love to have us offer the app in different languages. The challenge has been, again, finding the right operational support to make that possible. So it's not just having a translator who we can call with different questions. It would actually, for us, probably be either a full-time staff member or outsourcing the translation of the app into that other language in order to make it available on an ongoing basis. Because what we would want to do is if we offer the app in a different language, that we would support that indefinitely. And so that's a commitment that we want to make sure that we are prepared to make.
Gotcha. Yeah, I think it's an important consideration, as we continue to see the products evolve, and again, kind of creating that degree of inclusivity. It's good to hear and helpful to hear about what that means operationally for organizations working to build that out. We've got a couple of minutes. Yeah,
I was just going to add to that. So that our Spanish-speaking clients was definitely a big unmet need during COVID as well, which we discovered. So many people call us who are Spanish-speaking, and while things were changing so fast, there were so many things available online for people to access, but not necessarily always translated because things were changing just by the minute. And so we found our Spanish-speaking customers really needing more help to navigate all those different things because it might not be available in the language that they needed.
Interesting. Thank you, Kristen. So we've got a couple of minutes left. Thank you so much to all of our panelists for sharing, I think, really some insightful comments and things for us to think about. Before we wrap, I would love to ask each of you if you could offer one piece of advice, and relatively quickly, just a sentence or two, one piece of advice for other fintechs or nonprofits that are looking to collaborate effectively. What would you say? And why don't we start with you, Ronnie?
Yeah, I would say definitely align interest as well as the target group that you're looking to serve and how you're looking to serve them. And then point number 2 would just be make sure you have an internal champion on both sides that can really own the work and the execution of the relationship and the partnership.
Fantastic. Matthew?
Yes. So I think the thing that comes to mind is just ask the hard questions early. So, in these partnerships, it can be very easy for me, and I think even as we were growing as a company, to still kind of defer some of the awkward questions of how would this really integrate, or does this really make sense? Or, it's just I think the more you can bring those hard questions or around alignment, incentives, economics, mission, just hash it out, as deeply as you need to, before you even necessarily have an LOI or as you're doing more of the preliminary stages. I think the more we do that, the better and realer our partnerships are.
Great point. Those things exist one way or the other. It's good to get them out of the table early before you get too far down the road. Kristen.
My advice would be to start with a small, dedicated team who is comfortable with failing a lot.
Fantastic. And Jimmy, why don't you bring us home?
Agree with everything that's been said, but I'm going to go very tactical. The specific user experience of the partnership can matter a lot. For us, this has been a matter of whether the partner's website can work on someone's phone or not, or whether it's a pinch and zoom that is actually designed for a desktop, because all of our users are on mobile. We have realized that mobile first partners are essentially the only partners that we can work with because the technology won't work. So it might seem like a detail, but we've actually found it to be just a huge matter of whether users actually get the services that they're seeking.
Fantastic. Well, thank you, Jimmy. Thank you, Kristen. Thank you, Matthew. And thank you, Ronnie. Really appreciate your time and participation. And for everyone watching, I hope you enjoyed the session, and hope to see you again at Emerge Live. Thanks.
Yeah, thank you, everybody.
Thank
and
you.
Just in case it's relevant,
thank you.
my email is matthew@earnup.com. So if anybody wants to follow up or explore partnerships, just shoot me a note. And thank you. Thank you, Josh.
Hi, my name is Michelle Sloan-Jones. I'm the Chief External Affairs Officer for Money Management International, and I am so pleased to be here with you today. We have a really meaty topic to dig into, and it's one that I really hope brings you a lot of value. MMI is a national nonprofit provider of financial counseling services, and over the past few years, under a program called Project Porchlight, we have been providing financial recovery services to people who are working to overcome the impact of a natural disaster. Most recently, we have pivoted those resources very quickly and effectively to help people overcome the financial fallout associated with the coronavirus pandemic. I want to share with you today some of what we've learned through this process in the hopes that you can apply some of our lessons to supporting the financial health of your customers, clients, constituencies, and communities. When you picture a natural disaster, you probably envision things like infrastructure damage and uprooted trees and emergency vehicles. But what I want to invite you to imagine is the long, difficult, and often unobserved component of recovering from a disaster. That's the financial recovery. Financial recovery is multifaceted, it's multi-year, and it's impacted by the inequities that we know exist across race, gender, and socioeconomic status. We also know that attending to the financial health aspect of disaster recovery is absolutely critical to the long-term outcomes of impacted communities and their people for generations to come. So what does the research tell us? Unfortunately, there has been some really quality studies done on the long-term financial health impact of natural disasters. And what these studies generally show us is that low to moderate income households are both slower to recover and have a less complete recovery as compared to their more affluent neighbors. Now, why is this? One reason that may come to mind is pretty intuitive, and that's if you have a lower income, you have fewer discretionary dollars that are available that you can redirect towards your recovery. Another thing that might come to mind for you, especially if you work in the housing space, is the impact the disaster has on housing stock and affordability. But there are some other barriers to recovery that in our work have really stood out to us. And interestingly, those barriers are very similar to the barriers that we see when people are working to address a wide variety of financial challenges. The obstacles, the experience gaps, the mistakes that are made, many of those are the same. But what we also see is that if you provide people with the support, the tools, the education on systems that's necessary to address those challenges, you are also providing access to skills that can be leveraged outside of a disaster. You are in effect building financially healthier, more resilient, and financially capable communities and client bases. So here's the big idea. You can leverage your disaster response protocols to positively impact the financial trajectory of people's lives. If you're interested in improving the overall financial health of your clients, if you want to de-risk your customer base and your loan portfolios, if you want to improve the long-term financial stability and health of entire communities, investing in financial recovery after a disaster is a really effective way to do those things. And by investing in recovery today, you're providing resilience against disasters and other economic downturns tomorrow. So what are those common barriers? There are 5 that I'm going to share with you today. The first, experience dealing with red tape and bureaucratic systems. The second is limited access to credit. The third is identifying and avoiding scams. The fourth is a lack of familiarity with resources that are available to help. And finally, the fifth is experience modifying your budget and reprioritizing your debts in response to a crisis. So let's talk a little more about those. Experience dealing with red tape and bureaucratic systems. If you have experience filling out, perfecting, and existing documents, you are more likely to take the steps that require those skills after a disaster. And if you have successfully done those types of things previously, you have faith that those steps and those processes will work for you again. If you don't have that experience, it is completely unfamiliar. It's intimidating, and you're not likely to have a lot of faith in the process. It's also high consequence, because if you make a mistake and get it wrong, there's not a lot of opportunity to go back and make that right. Navigating through those systems and processes is a skill. The second, access to credit. When recovering from a disaster, most people rely, at least in part, on credit to help them get through. If you have a lower credit score, you're less likely to qualify for loans and more likely to turn to non-traditional forms of credit, sell your belongings, or simply not make progress, sometimes for years. Evaluating your options for credit, making the right use in the right order, understanding and making good decisions about the trade-offs to impact your credit score, that's a skill. The third barrier, identifying and avoiding scams. It is incredibly easy for bad actors to convince you to pay for something and then never show up again. If you don't know that FEMA shouldn't be charging you for an inspection, it seems reasonable to pay for this. It seems official. It's not. Learning to identify and avoid scams, that is a skill. The fourth thing, accessing resources that are available to help you. If you don't already know where to go for help, figuring that out after a disaster is nearly impossible. People who are connected to community groups, who understand their resources, the supports to which they're entitled, those people are more likely to know where to turn from help and to be successful doing so. People who don't know where to go and are likely to get left behind. Identifying and understanding the network of resources available to you, that is a skill. And then finally, the fifth thing, experience with modifying your budget and reprioritizing your debts in the face of a crisis. Understanding the trade-offs that you need to make today to help cover your needs while also protecting your options for the future. That is a real balancing act. We make emotionally driven decisions about money all the time. And in the aftermath of a disaster, that is no difference. That's no different. But we know that with the support of an expert guide, we can help people make decisions that advance their position over time. And this is a skill. I've referenced these repeatedly as skills because they are acquirable. But in the wake of a disaster, this is a ridiculously steep learning curve. And asking people to learn a new skill set in the midst of a crisis when their world has been upended is just not realistic. But if you provide access to an expert resource, a financial coach to help you along the way, your clients don't have to have all those skills themselves in order to be successful. They will have access to their coach's skill set, and working with an expert through that process serves as a critical transfer of knowledge. However you do it, whether it's through a financial counseling resource like Project Porchlight, whether you build it yourself, whether you find another resource, if you attend to the financial health of your clients, your customers, and your communities after a disaster, you will be creating healthier clients, customers, and communities overall. And I would also suggest that with these supports in place, what you may find is that your customers and your bottom line continue to improve to the point where it makes sense to expand your services from the inflection point of a disaster to a standing business practice. I want to take this for you from kind of this theoretical and bring it home for you in a very real kind of way. And to do that, I'm going to tell you the story of one of our clients, Linda. On November the 8th, 2018, Camp Fire swept through the town of Paradise, California. The fire took the lives of 85 people and destroyed most of the town, including Linda's home of 23 years. When Linda called MMI more than a year later, we were literally her last resort. Linda and the other survivors of Camp Fire had had to wait almost a year before they could return to the town. That was a year of uncertainty, a year of trying to replace lost belongings, and a year of being apart from their neighbors, their faith organizations, and their social support systems. It was also a year of feeling like the rest of the world had moved on and that they had been left behind. In working with Linda, she had struggled with 4 out of the 5 barriers that I had told you about earlier. The first was experience dealing with red tape and bureaucratic systems. That was a skill that Linda just did not have. When she came to us, she'd been denied assistance from FEMA. She didn't know that she could have appealed that denial. Linda had been deeply traumatized by the fires, and she was attempting to apply for an SBA loan. She was unable to get through the form, in large part due to her trauma. As a consequence, she missed the filing deadline, which she felt incredibly guilty about, and which added further to her trauma. The second challenge was access to credit. Linda had already applied for loans to rebuild her home and been denied. She was living on a fixed income and she couldn't qualify for the full amount that she needed. Linda had made a very common mistake. She used her insurance money to pay off her mortgage. That meant that she had very little left over to rebuild. Thankfully, the third barrier that I spoke about, scams, that's the one challenge that Linda did not encounter. But the fourth, access to resources. When Linda came to us, she was in tears. She thought that she was out of options and had exhausted all of her resources. But in fact, that just wasn't true. As a matter of fact, through the course of our work with her, Linda was able to apply for a variety of resources, including a special grant for survivors, a small low-interest rebuilding loan, and a loan from the town of Paradise that was specifically designed to help cover the gap between insurance proceeds and the actual cost of rebuilding. And the fifth challenge, experience modifying a budget and prioritizing debts in response to a crisis. When Linda came to us, her budget simply was not in alignment with her current reality and with the next steps that she needed to take. Linda's counselor was able to help her build a budget that fit both her income and supported her long-term rebuilding goals. Linda is in the process of rebuilding her home today. When she finishes, she will have already paid off part of her loans, and the remaining loan payment will be well within her budget. Today, she better understands her loans and her insurance. She's also able to contribute to savings, and she is already financially healthier and more capable than she was at the time of the fire. If you give people the support, the tools, and the education on systems necessary to address these challenges post-disaster, you're providing a path to full financial recovery for people who could not have gotten there otherwise. And you're providing access to a skill set that can be applied outside of the disaster. You can leverage your disaster response protocols to positively impact the financial trajectory of people's lives, which is exactly what we saw with Linda. There is so much good that can be done when you put supports in place to help people overcome financial challenges. And by doing so, you're also building resiliency so that when the next challenge comes along, those people are more equipped to handle it. They come from a stronger starting position, and that allows us to redirect aid, support, dollars to the next group of people who need our assistance. There is a lot of good work to be done. We know how to do it, and I hope you will join me. Thank you.
Hello, everybody. I'm Brandy McHale. I'm the head of community investing and development at Citi, and I'm so pleased to be with you today, although virtually. I don't think this is going to in any way inhibit our conversation. I'm here today with Maurice Jones, who is the CEO and president of the Local Initiatives Support Corporation, one of the longest standing, most accomplished community development intermediaries here in the United States. Maurice and I have worked together for a long time, so I actually do feel, Maurice, like this will be a conversation, just for a chance for us to catch up. And it's a really important conversation for us to have. I think over the past few months and weeks, I think you would agree, we have all been on overdrive, responding to these unprecedented times that we're living in, making sure that we don't erode the gains that we've accomplished, while also trying to figure out the path that we need to chart for the road forward. So thank you, Maurice, for joining me. And why don't we start off and have you tell us about LISC and in particular your work to promote financial health.
Sure. Well, nice to be with you, Brandy, and hope you're well in this unprecedented time for us. Just to sort of repeat, LISC is a large community development and development finance organization. And most people know us for the capital that we invest in housing projects and small businesses and community facilities. But we actually have a lot of work that's in the promoting financial health space for individuals. And thanks to partners like Citi, we have a network of what we call financial opportunity centers around the country. And they are organizations that are community-based organizations that we invest in to enable them to do three things. They, through a coaching model, provide financial literacy coaching so folks can understand what they need to have a budget that balances, so they can wrestle debts to the ground, so they can get a credit score that will put them on a pathway to a relationship with a mainstream financial institution. Second piece, really case management around the things that workers need to be productive workers: housing, transportation, childcare. And then thirdly, it's workforce. It's the hard and soft skills you need to acquire and retain a livable wage job into a career. That work we're doing in 100 places around the country, urban and rural, And there's more work to be done for sure.
So 100 places, and those places are all at different points in how they've experienced COVID-19, but I would imagine that just about all of them have had to deal with stay-at-home orders, and to have your team switch to a remote environment at a time where I would imagine if we didn't have those stay-at-home orders, there would be a line out the door for the services that you provide. So you just talk a little bit about how you've adapted the business model and how you've overcome some of those challenges.
Yeah, absolutely. So first and foremost, our financial opportunity centers have moved from trying to work on the long-term attributes that people need to actually obtain and retain jobs that pay livable wages to more immediate needs. So our financial opportunity centers now, through the coaches now are helping people access unemployment insurance, access benefits like TANF, and access relief around LIHEAP and those kinds of benefits. And so you see a lot more of that. In addition to that, our financial opportunity centers are providing more immediate short-term relief payments and helping folks to pay their rent and those kinds of things. So you see them, particularly the coaches, really making sure that they can help people navigate through this tough period that we're in right now. In addition to that, you see the financial opportunity centers themselves learning to actually provide services remotely. And so we have had a fair number of requests for help with laptops, so that the financial opportunity centers can actually provide coaching remotely. We also have had a fair number of requests from the financial opportunity centers on behalf of their clients who don't have internet access. So all of that is part and parcel of what the financial opportunity centers are doing to adjust to the moment. And I have to add, for us, the key is we've got incredibly flexible partners like Citi who have allowed us to repurpose the assistance that you gave us so that we can be relevant to what our financial opportunity centers need right now. And I thank you for that.
Well, we thank you. In fact, I say two things. One is I'm really struck by the move to digital. It's so interesting in the work that we do in communities. We've been big proponents that digital is a way to create access, but yet we've actually been behind in our work in thinking about how we digitize our service delivery models. So it's been interesting for me as a funder to think about what can we do to help to accelerate that, as you've been thinking a long time about how do you actually continue to get to scale and have models that can scale. So I think it's been an unfortunate moment to have to build the airplane while we're flying it, but it's been really amazing to see it. And I do also just want to point out, we, all of us in this country, have talked about first responders and have looked at people on the front lines that have kept our country going and have acknowledged and thanked those first responders. But I think some of the most unsung heroes are folks like your financial coaches that are in the financial opportunity centers that said, no, I can't just stay home. I have a job to do. And it's not just about the immediate relief, but are really going to have to be there for the long haul as we shift into recovery. So first, thank you.
I couldn't agree more. Thank you, but the coaches, the magic of the financial opportunity centers is the relationship between the coaches and the clients. And those coaches are like zealous lawyers on behalf of their clients. They learn what they have to learn in order to serve their clients. So now coaches are learning about unemployment insurance. They're learning about TANF. They're learning about the CARES Act. And they are mastering it so they can serve their clients. So you're right. I mean, the secret sauce of these financial opportunity centers even in an age of digital delivery, digital revolution, is still the relationship between the coach and the client.
So for me, one of the most, the best days that I have doing this type of work is when you have the opportunity to actually go out into communities. And I want to shift a little bit and talk about what you see and what's happening on the ground in local places, real people. I can only imagine that we have the stress of a health crisis that turns into an economic crisis that is now turning into a social crisis. And that's, as that social fabric erodes, how these three areas really come together. And so, you know, while I've been so proud to go out, especially when I've had the chance to see the work up close and personal, and to talk to your clients in the financial opportunity centers, to really understand that, you know, again, I really want to stress that you take a holistic view. It's not, there's one silver bullet that's going to make the difference. It's the access to a job, it's housing, it's the extra education, it's childcare, it's all those pieces. And I know that LISC has single-handedly made a difference, a meaningful, measurable difference in breaking the cycle of poverty for tens of thousands, if not hundreds of thousands of families over the years. And while I know that, and it warms my heart, I'm troubled, and what keeps me up at night is that there are so many that we're not reaching. And I want to actually make sure I get this fact right, because this is really what I think is at the heart of this. So this is what keeps me up at night, Maurice, and I'd love to hear your reaction. Mm-hmm. Today, if average Black family wealth continues to grow at the same pace that it has over the past 3 decades, so forget the past 3 months, we'll put those aside, the past 30 years, it would now take Black families 228 years to amass the same amount of wealth that white families have right now. And what really bothers me about this is when I think about that 228 years, that is just 17 years shorter than the 245 year span that we had slavery in this country. And for Latino families, the situation is better, but it is still not where it should be. It would take 84 years for Latinx families to amass the same amount of wealth that white families have today. 84 years, we will be in the next millennial. We will be in the 3000s when that happens. So, you know, I know you think about these trends, you know, share your reaction and your thoughts to this.
Yeah, you know, my reaction is it is a real instructive data point for just how much is left to be done if we really want to get at the determinants of wealth. And I think this is what we really need to be thinking about. I have said to folks that if we really want to really close and or eliminate this wealth gap, then we have to have the same approach to Black and brown folks in America and low income, low and moderate income neighborhoods in America that we took to Europe after World War II. We have to have a true Marshall Plan for these people and these communities. Because what you need if you're going to eliminate that kind of wealth gap is to understand that it means you've got to have quality schools for these children, quality daycare for these children. It means you have to have access to higher education. It means you have to have jobs. It means you have to have healthy food. You have to have a comprehensive and you have to have a long-term strategy for truly shrinking that wealth gap. We have not really had that in a sustained way in our country, focused and intentional on these racial wealth gaps yet. Now, I'm encouraged because we might be at a moment where we can actually persuade a broad enough coalition that this is a body of work that we should do. The other thing that I would say is what I'm encouraged by is we've seen our work. We know that actually our work actually can help individuals transform their lives and the lives of their communities. So it's not like we have to go guessing at what the components are. We just have to find a way to scale it. That takes a national commitment. We have not had that yet. I'm encouraged, though, that we may be on a moment, on a precipice where the country actually is ready to choose to have a Marshall Plan for these communities, for Black and Brown folks in America, that we can sustain for years. If we do that, I promise you, all those eventualities that you mentioned, they will not come into fruition.
Yeah, it's interesting because I love what you said. We have tactics, we need scale, and we also need political will.
Absolutely.
But I also, thinking about these issues, have thought about one thing that's also, I think, needs to be different. And I love this concept of the Marshall Plan. I think that's it's a precedent. We know it works. It's worked before, right? We know it works. Let's bring it out again, right? There are no new ideas. They're just ideas whose time has come.
That's right.
But I do think that we need to think about this not just as we are solving a problem. There's also the reality that our country's demographics are shifting. We will be a minority majority country by 2040. And so I don't think that this is also, we should have an abundance mindset. I heard that expression the other day, and it reminded me that that's actually also been at really the heart of what LISC has been doing, is to say, we're not, communities where there has been disinvestment doesn't mean that there's no opportunity. You know, if you had to think about places in this country where you've seen communities really turn around, you know, what are some of those places? Because I want us to all have hope that we can do something to reverse these trends. Where have you seen this work the best?
So a number of communities. First, let me go back to what you said. Yeah, I come at this from the perspective of this is our opportunity. There are, to your point, there are geniuses in every community in America. The question is how we partner with those geniuses to catalyze opportunity. And the real sort of invitation or demand is that's the only way we make America great. To your point, where have places actually turned around who've actually really done this work? Indianapolis, for me, is one of those key places, a place where the city and where the Lilly Foundation and where LISC and where community partners have come together, and they're building things they call great places, and they're investing in small businesses. And what Indy has done and what's going on in Indy right now is an incredible transformation that they've made in the last decade plus that I will tell you that they've been working on. And they would be one of the models that I would hold up as a place. And by the way, it's biracial, it's multiracial. You've got hospitals now getting into the game, but they had what you are actually suggesting. They had the political will, they had a really committed philanthropic sector, and they had a corporate sector that has come along, and they've got residents empowered in the work. That's a place that I would suggest to you that is well worth looking at. And then there are other places where you can actually go and find neighborhoods where folks really have turned around. West Philly, You can find neighborhoods that 10 years ago, you literally had abandoned lots. We've got these before and after pictures where you can see the pictures 15 years ago and the pictures now. And the difference is people coming together and committing to developing a place. This model is eminently doable. We really do have to sustain it and take it to another scale.
So I know that we can't see everybody, but I know that we are being viewed and joined by many innovators and being connected digitally. I just want to ask you for a moment, what role does technology play in all of this? Are you finding that communities that get this right are also really leveraging tech innovations in a different way?
So what I'm finding now is a couple of things. One, communities that are getting it right now also have technology companies participating in the actual development journey. That's one. Number two, there's no question that technology is also a huge accelerator and enabler of this work. So you can't reach businesses or people if you can't reach them with Wi-Fi, then our ability to truly help folks progress will have serious limitations. And so what I'm finding is you have to have technology to do all of this work. And where you have technological gaps, rural America, it makes the work much, much harder. So part of the Marshall Plan, in my mind, is a commitment to having no households without access to the internet, no small businesses without access to the internet, no nonprofit social service providers without access to the internet. And right now, we don't have that.
I do think, though, the past few weeks, over the past month, the recognition that the private sector has such an important role to play in solutions, both looking at how the private sector hires people, conducts business, engages in communities. Any advice for those of us that are in the private sector and listening about things that we can do that you think would make an immediate difference? And I will put a plug in to say, I think there's an opportunity for many more to partner with LISC. So if you want to jump in, there's more than enough room for others.
I certainly was going to say that, but look, I think what private sector enterprises are, and what that means is understanding that your hiring really is powerful, and you really can create a pipeline that's inclusive of individuals from multiple communities to empower them and to help them get the skills they need and the wealth they need. Your procurement dollars, the businesses that you're using as suppliers, they matter, and you can make a difference. You can help build women-owned businesses and minority-owned businesses and Latino-owned businesses and Black-owned businesses. You need to reach out and have a program that affirmatively brings them into your procurement practices. Your purchasing, where you're purchasing goods and services from, these things matter. So yeah, I think, and to the credit of the folks that we are working with, I don't think this will be news to the corporate sector, to the private sector, because we see so many of them stepping up and embracing this, but it's hard to overstate the actual transformative power that the private sector has. And now, as we're going through this journey where racial justice and racial reconciliation is at the forefront of our nation's journey, the role that the private sector plays in both convening people and giving people spaces to be reconciled, and actually working with other coalitions on reform in the criminal justice system, and working on hiring folks and working on promoting folks. That is the transformative opportunity that the private sector has had for a while, and that I hope they will embrace with gusto moving forward. Without that, we will be limited in our progress, no question.
Yeah, well, I think it's also an interesting time. What you're saying is that we don't need to build something new. Use the existing rails that we have, just change the direction that we're going in, be more intentional about it.
Absolutely. This is a matter of us making the choice again, by the way, to really create a more perfect union and to really use the assets that we have to get there. And we have them. We are still the most powerful enterprise in the world. We can still do miraculous things. I know we can do it here. This is a matter of, being hungry for it and being willing to work at it for a long time. And my hope is we're on the precipice of making that choice again.
Well, first of all, those words are both very exciting and also calming, because we're not starting from a blank sheet of paper.
No,
we have ideas, we have things that work. So that's very calming for me. I shared what I want to know. We have just a moment before we close out here. I shared with you and everyone else what keeps me up at night, but I want to close by asking you the flip side of that question. What would help you sleep better at night now?
Yeah, I think it's what we're talking about. If we could truly get explicit commitments from the public sector and the private sector that we're going to adopt and pursue a Marshall Plan for our toughest parts of America, man, I know we can figure it out. That part I'm not worried about. I would sleep much better at night, both for those communities, but even more importantly, for the future greatness of this beloved country that we all, care about.
Well, I have to say, we need your organization more than ever. We need your voice. And I know that your voice today has inspired my own voice and many others. You are in 100 places. I think we need to be in 1,000 places. And then I think we need to actually be grappling with the issue of what are you going to do, because you actually don't need to be in business anymore. And I hope that day comes.
I look forward to that day.
Yeah, absolutely. So any last word of advice, and especially I want to bring it back to the Financial Opportunity Center model. If people are interested, want to learn more, want to get engaged, how can they reach out to you, your team?
They can reach out to us on www.list.org. And these financial opportunity centers work. And the other thing I should have said about them is, look, LISC doesn't operate any of these. We go out and find local community-based organizations and partner with and invest in them and help them to transform into a financial opportunity center. And we can't do it without cities' help. So to your point, we have 100, we need 1,000. So come with us on this journey.
Great. Well, for everybody that was listening today, thank you so much for the opportunity to talk with you. I'm so great to see you, Maurice.
You too.
We really appreciate it. And we will talk soon.
Thanks for all you do. Appreciate it.
Thank
Stay
you.
well.
All right. Thank you.
Good day to everyone. Welcome to the final session of day number 2 of Emerge Live. My name is John Thompson. I'm the Chief Program Officer here at the Financial Health Network, coming to you live from Kansas City. I am joined today by Abby Wemimo, the co-founder of a company called Isuzu, which describes itself as a mobile platform designed to empower its users to better save income, access larger sums of capital, and build credit and financial identity through community-based savings. We're going to have a conversation today about leveraging fintech data to uplift vulnerable communities, but we may get into some other things given Abby's personal and professional background, as well as his unique perspective on the communities that Isuzu is trying to serve. Our quick 30-minute conversation wraps up a series of sessions around today's theme of looking ahead, an integrated financial health system for all. So Abby is joining us from New York today. Welcome, Abby.
Thanks a lot for having me, John. Very, very excited to engage in this dialogue.
I am looking forward to getting into some of your thoughts about the role of data and how we can use data to affect outcomes for the people that we hope to serve. And I want to talk a little bit also about your company, Isuzu. But before we do that, I wanted to give you a chance to introduce yourself, talk a little bit about your background, what has brought you to this point, and how you think that may be helpful to you as a leader, as a founder, as a person of impact.
Thanks a lot once again, John. I started my journey in the United States. I was born in Lagos, Nigeria. I grew up humble backgrounds, lost my father at the age of 2, had the opportunity to come from average 78-degree weather to negative 22 degrees in Minnesota. It was very cold, and I came to the United States for study in January. It was such a character-building experience, starting my career working for President Obama's re-election campaign in the northwestern region of Minnesota, where the campaign I was trying to represent didn't quite reflect the values of the folks we're sharing the ideology with. But that taught me a lot of things. It taught me to listen to people that are different than I am from an ideological standpoint, and then from a philosophical standpoint also. So fast forward, I came to New York City for graduate school, started a company really focused on open data. I'm on the African continent with the former chief technology officer for President Obama. That company was acquired. I went on to Accenture, PricewaterhouseCoopers, and Goldman Sachs. PwC was really focused on mergers and acquisitions. So what happens when you buy, sell, or separate a company? Particularly when it comes to Isuzu, my journey to the United States and what made my co-founder and I start this company was really due to financial marginalization. When my mother and I came to the United States, particularly in Minnesota, we walked into one of the biggest banks to borrow money. We were turned away because we didn't have a credit score or a financial identity. We walked down the street and borrowed money from a payday loan lender at over 400% interest rates. In addition to that, my mother sold my father's wedding ring so I could get a fighting chance in this country, because as an international student, you don't get financial aid or the Pell Grant. So we built Isuzu on a simple premise. Regardless of where you come from, the color of your skin, and even your zip code shouldn't determine where you end up in life. So that's a little bit about me.
I really appreciate you sharing that. And the concept of financial identity, I know, is essential to the work that you're doing at Isuzu. And it's also been, I think, a big part of the conversations that we've been having in particular today at the Emerge conference. So we've got to come at this from a few different angles. But I wonder if you could tell us a little bit about what Isuzu is, what it's designed to do, what its role in the financial services ecosystem and the financial health ecosystem is. Just talk a little bit about that as well.
Thanks, John. So at Isuzu, what we do is really simple, and our core belief is we want to use data to better humanity. The question is how. Our core focus today is to help people save, but particularly our business has evolved into capturing rental data and then reporting it into the credit rating agencies to help people establish or build their credit scores. You might ask, why is that important? 1% of rental data are reported into the credit rating agencies today. And then for the communities we care about, particularly the Black, Latino communities, 65% of this population rent. And that's a derivative of some historic marginalization which we've experienced in the United States. Number two, if you have a poor credit score, it can cost you over $250,000 in interest over your lifetime. So we asked our user base and said, look, what's the fastest way to actually have the biggest impact in your life? And the answer was profound. Help me improve my credit, because I don't want handouts from the government. I want a fighting chance. And that's what we do at Isuzu. Help people improve their credit, see credit as an asset, so we can continue to help them pave that permanent bridge to financial access and inclusion.
I appreciate that. Do you see yourself as a service that's used directly by consumers, or are you planning to build a data platform for consumption by other organizations?
That's a great question. Right now, we have built a platform where different stakeholders can participate and engage with us. On the savings side of the house, we've opened a platform to big institutions, community-led institutions that have financial opportunity centers across the United States to be able to leverage the technology we've built. What we do know how to do at Isuzu is build outstanding technology that folks that are in the community can leverage. We don't know it all, and we're not trying to be the jack of all trades. So we're unlocking our technology so folks can engage. And number two, when we think about the data from a savings standpoint and a rental standpoint, it gives us an end-to-end view. And then the combination of that data, and when we present it for things like underwriting or financial access, it becomes second to none. And that's the kind of vision we set out to do, to really make sure folks see this as an opportunity to build a more buoyant and complete financial identity.
Okay. So talk to me a little bit about the interplay between the rental data that you are collecting and you talked about, and your website talks a little bit about Isuzu also as a savings platform. How do those two things connect, and why is that important both for you and for the people that you're serving? Stakeholders, I mean both individuals and platform companies that want to use your data.
That's a great question, John. I'll answer that question with a story. So my mother's very good friend in Minnesota also moved to the United States with no credit score. And one of the biggest things she wanted to do was put down a down payment on a home, because when you come from places like Nigeria and predominantly immigrants, you're scared of the concept of debt. So there's a lot of education there. So what they usually do is a collective of women, they save money together and take turns withdrawing that capital. They were actually one of our biggest use case when we started Isuzu. So they were able to save, close to $35,000 just rotating capital amongst themselves. But then something bad happened. To answer caller, what happened was she had a medical emergency. She didn't have health insurance, unfortunately. A majority of that cash went away. The question for her now was, how do I get access to cheap capital? Because they're actually scared of being indebted to folks. Very common in immigrant community. So when that question was posed to us, and majority of users, it was really simple. It was, how do we create a system for folks to have the right financial identity so they can get access to good financial products? So the continuation of our products from a saving standpoint, if people have enough cash, they will save. But the issue is the income is just not sufficient right now. So what happened to my mom's friend is she had to get cheap capital. And the options that were only available to Auntie Caller was credit card, but she needed something liquid, and payday loan was an option. That is the same thing, the same experience we went through. That shouldn't be the status quo. Just because we can underwrite people and get the right data, we can't stop there. It is not good for the society, and it's not even good for the American economy at large. So what we thought about at Isuzu, really simple, was, look, if folks can save, let's report that data and help them establish a credit score. If folks cannot save, let's take it a step further and think, what are the current things they're doing in their lives that we can capture the data, report into the credit bureau. So when they walk into a bank, they're not turned away. The banks don't lose trust. And today, John, there are over 40 million people in the United States that don't have access, they have a thin credit score or no financial identity at all. Imagine, and the average debt in the United States is $135,000, including mortgage. Just imagine if we do that simple math, 40 million times 135,000. That's $6 trillion in capital. That's not just a good thing for the American economy. It is a profitable thing for the American economy. And that's the way we need to think about the population we're trying to serve. We're not just trying to prove a charity case. We're trying to make sure people like Anticola has a fighting chance and makes America, continue to be a more profitable scenario. So that's what we're fighting for. And that's why we think an end-to-end platform from saving to credit building isn't just the standard, but should be the standard people adopt.
I want to come back and get in a minute just a little more of your perspective on kind of what your the communities that you're trying to serve are wrestling with and sort of the state of affairs in this country today. But I did want to just double click on the platform concept that we talked about, that you talked about. There's a bunch of technology platforms out there. There are a bunch of sort of incredibly large, complex, and sophisticated organizations that are providing data to financial services providers. Why is Isuzu necessary? What is it that you bring to the market that others aren't delivering?
Great question. I'll give you an example, John. I love telling stories. The best way to answer this question is really with stories. So let's take, for example, our rental platform. What happens on our rental platform, our rent reporting platform, is we work with large landlords or any landlord, capture that data and transform it. And I'll speak to our 3 core value proposition. When we capture rental data and report it, it drives on-time payments. And then we're also able to see risks data and make sure folks are not kicked out. So let me juxtapose and be very, very clear. Number one, when you think about the traditional institutions, the way the financial sector is structured today, you have the folks that are either moving capital, you have the enablers in the marketplace, or you have the neo institutions borrowing someone's fiduciary identity to make transaction. Well, the way we see ourselves as an institution is really unlocking capital and that enabling bucket. And why Isuzu is different is, imagine, John, you leave, you're a landlord, I rent in your building, you're helping me report my data with Isuzu, and for some reason, I lost my job. Isuzu has access to that information and can predict the risk, but it doesn't stop there. Isuzu is not trying to make sure Abby gets kicked out of John's building. You know what Isuzu does? Number 2, Isuzu connects Abby with an affordable interest loan on an average 0 to 5%. So Abby can get access to that loan, pay John, so Abby doesn't get kicked out and we're not solving homelessness backwards. That's the kind of solution we're thinking about, and that's our difference. End-to-end solution, not just taking a piece of the pie, because you can't just solve a part and leave the rest. You need to think about the end-to-end whole solution. So that's how Isuzu differentiates itself. It is not just stopping and reporting data. It's leveraging that data to just make sure the outcome, which is equal financial access at a cheap rate, and particularly on our rent reporting products, homelessness, is drastically reduced, and that's what we're able to control. So the standard in the market, there are a lot of good players doing good work, but it's just really focused on one thing. We think, particularly at Isuzu, we can't just stop at one thing for dealing with a particular population.
I appreciate you sort of bringing the context or the concept, I guess, of outcomes into the conversation. And I think, that's one of the things we've been really working with the markets and with our members to think about. How do you design for the outcomes in mind? How do you build for those? How do you measure yourselves to those? I'm going to throw like a super technical, tactical question at you that's COVID specific at the moment, and then we're gonna pull back a little bit. But I think this is something that many of the people in the audience today, the virtual audience today, have been asking about. So the question is from the audience. How are you dealing with COVID-induced rental deferrals or delinquencies in the context of reporting to credit bureaus? And if you want to expand on that and think about the broader implications, please feel free.
It's a fantastic question. So let's start from step one. What we did when COVID happened, for all the landlords we work with, we have now close to 200,000 tenants in our ecosystem. What we did was checked on our landlords, number one, and say, what's the game plan? What are the biggest needs you have? One of the striking things, and from the data we have access to from the property management software company, where 65% of folks in our ecosystem will not be able to meet their rent obligation. Moratorium or no moratorium, everyone suffers. The landlords can afford his or her mortgage. And then the renter is at risk of eviction after the moratorium. So that's a background. What did Esusu do? What we did was create a rent relief fund, went back to our impact investors like Acumen America, like the Global Good Fund, that really invested in us due to the work we are doing, to really focus on giving folks a fighting chance, particularly with our financial identity. And we went back to our landlord and said, hey, we raised the rent relief fund, make sure people do not get kicked out. We're going to step in and pay rent on their behalf. So what we've been able to do is keep folks in their homes, and in some cases, taking it a step further and negotiating with landlords and saying, if we pay this amount, after the moratorium, promise us you won't kick them out for additional 2 months while we find other services. That's a tactical way to leverage capital, and I really have an impact. So let's address some of the questions that came from the audience. Number one was really, how do we deal with reporting? Thanks to the CARES Act, if you have any financial shock associated with COVID-19, we have a special code agreed to by all 3 credit rating agencies that it's not going to affect your credit score, provided you reach out to us. And if you don't reach out to us, we have a huge customer support team that reaches out to you because there's a lot going on. And we take that step, and we think it's a fiduciary responsibility, not only for our shareholders, but for the people we serve, and we don't take that for granted. And then when rent moratoriums end, my answer is we need more Esusus, right? Look, what is up? We have 62 million units in the United States. There's a big article came out from the Washington Post and Politico that said 82% of folks that will be affected when rent moratorium ends are African Americans and Latino population. And if you take a step back, the 18% are white, but let's figure out where the white folks are. And places like, Grafton, North Dakota, places like, Mahnomen, Minnesota, in places where in all reality in our dialogue we've forgotten about. So, poverty doesn't necessarily know color, but it disproportionately affects a certain class. So what we've been able to do and what we continue to clamor for is we need to find a solution that does not necessarily victimize the landlord, but we need to find a win-win solution like companies like Esusu have figured out, where we get landlords paying their mortgage and continue to employ folks, and we keep the renters, the people we care about every day, in their homes, because that's the right thing to do.
I appreciate you mentioning that. I think there's a couple of themes from some earlier presentations that carry forward into what you're talking about. Matt from EarnUp talked about the role in partnerships of making sure that you think about the experience that each sort of stakeholder in that partnership has, both the people, the companies, so on and so forth. And then Michelle from MMI, who spoke just a few moments before us, talked a lot about some of the barriers that people face when they're approaching a financial crisis. In this case, she was talking about disaster recovery. Obviously, we're in an interesting kind of disaster at the moment, and how that can be a really important teaching moment, and how you can invest in the people that you're working with to help prepare them for the future. So I've got one other audience question that I want to get to that's fairly tactical before we sort of zoom back out to finish our conversation, Abby. So the question is this: if a property manager uses your services, do renters get to opt in or opt out of having their rental data reported? For example, if someone is typically late on the rent, they may not want their data reported. Is that something they control? How do you do it? And I think it'd be interesting also to hear, how do you think about that as a business question, as a customer focused question?
You know, we have a very intelligent audience, and it's really exciting to get the tough questions. So when we think about what we do at Isusu, we leverage the letter of the law to benefit the tenants we serve, particularly in this case. So what we're able to do from an opt-in standpoint, so our standard operating procedure, the question's answer is really, it depends. If you're a market rate landlord, you can opt in to have everyone report data on the Isusu platform. And then we watch for folks that miss their rents in an effort not to hurt their credit score. They have an opportunity to opt out of the program and say, hey, I don't want my data reported. And that's in accordance with the Fair Credit Reporting Act. But if it's public housing or mandated by law, particularly the 1974 Housing Act and other privacy acts, make sure folks can opt in before this data is reported. So our system actually uses a text message approach and say, Isusu is going to report your data to improve your credit score. You get a text message, do you want to opt in? Yes or no? You click yes, you type yes, we get that data, and now we're able to report that data on your behalf. If you say no, you're respectfully disenrolled and none of your data will be reported. So that's really the power of what we're doing. And we're able to treat the opt-in basis. And then for folks that are auto-enrolled at the request of their landlord, predominantly private housing providers, if folks miss their rent, we're going to reach out to them and say, you have this option by law. And that's, from our vantage point, it's the difference between the letter of the law and then the spirit of the law.
Appreciate you going down that rabbit hole, a small one. I did want to take a little bit of a step back, and I think this is a unique moment of learning for many of us in this country. You and your team are doing this work at an incredibly chaotic time. You're building systems and processes and tools that are designed to change the way that the sort of functional systems in this country work. And I think we as a community are finally starting to hear some new voices around generational issues of racism and exclusion that are in many ways embedded in the roots of the country. And the financial health of people and neighborhoods and communities are, of course, deeply connected to this. As an organization that's focused on systems change from the inside, and as a leader from your background and a leader in this section, I'm just curious about hearing your perspective of sort of how things are playing out in the communities that you're working with, and how you take either inspiration or learning or want to affect the narrative in this particular country right now.
It's a powerful question, John, and the data we see every day is not encouraging. The reason why we find ourselves at this inflection point in this time of history, in the dialogue we're having, in my opinion, it's a symptom of a larger disease that went back through the original sin of this country, which is slavery. And then that was exacerbated by Reconstruction, Jim Crow, and then fundamental discrimination, particularly from the Federal Housing Authority, discriminating against African Americans and not getting access to financial products. Hence why we have the big wealth divide, whereby a white family has 10 times as more wealth than a Black family. So we all know this fact. The question is, where do we go from here? From my vantage point, some of the things we're saying, and when people fill out their rent relief form, we ask them to create just a free-form text of what's going on in their lives. And one that touched me, and I cried myself to bed, was essentially a family of 5. This mother of 5 earns $722 every month. Service employee got furloughed and now can't afford rent. In a just America, that shouldn't happen. In a prosperous country like we have, the most successful country, the richest country on the surface of this earth, that shouldn't happen. So we need to really look inward and use this point as an inflection point. And whatever is going on, particularly with COVID and the uprising from the people that have been left behind, our people, is just a symptom of that larger disease I talk about. So where do we go from here? Some of the ideas I think we should think about is for folks that have a thin or no credit file, we need a $2 trillion plan that gives financial institutions and other fintech lenders an ability to lend to these people. And that $2 trillion is loan loss reserve fund. If John, you don't have a credit score and we don't trust you, let's presume innocence before guilt. Let's give you access to financial products, and the government should step in with a loan loss reserve fund. That's how we can level the playing field that we've fundamentally disrupted from the federal housing discrimination and other disease we're dealing with from slavery. So that's one of the biggest ideas and one of the things we need to think about. Number two is just collaboration. We need fintech providers, we need folks working in social services. The Financial Health Network does a great job with that, with the nonprofit exchange, bringing fintech providers and then folks working in nonprofits to really bring us together to work hard to solve particular problems. Then we need the government to step in also, because it is just, there's so little we can do without the government setting the record of what needs to happen and the government spending a lot of capital. Let's think about what just happened. What I'm introducing is not radical. It's just $2 trillion. We've released it's funny, John, but we've released $7 to $11 million in free cash, zero interest cash for corporations to lend. The Federal Reserve Bank is buying up junk bonds and then commercial paper. Think about that. That's $7 to $11 trillion. In these United States, we've opened up the bank and folks can just come shop at zero interest. Why are we not doing that for our people? Why are we not doing that for people we've left behind? If we want to right the wrongs we've experienced, it's time for us to stop nickel and diming and bet on our people, because every time we've bet on the people of these United States, we've continued to show that we can be the best and stay the best and show the world that we can really prove the soul of what this country stands for. So the data I see every day is not encouraging. Collaboration will take us a long way. And I'm really confident that the best is still yet to come, only if we do the right things.
I think I want that to be the last word of the day. Abby, thank you so much for sharing your time with us, for sharing your perspective and insights with us. This set of conversations today were really focused on the future and on the opportunities and implications of a more integrated financial health system that has inclusivity and equity and fairness at its core. And I think you really brought the concept to life in a way that I think can hopefully inspire all of us to continue learning. For those of you in the audience, please continue to follow Abby's work at isuzurents.com. You can also follow him on Twitter at @wemimo11 or at @getasuzu. Thank you again, Abby. Have a terrific day, everyone.
Thanks a lot, John.
Abby, thank you
Abby.
so much. That was awesome. We really appreciate it.
Thanks,
Thank you, John.
That was great. Okay, Abby, I'm going to go drop to the next session. Really appreciate it. I'm confident we will have necessary follow-up. Can't wait to meet you again. So talk to you soon, okay?
Bye.
Take it easy.
Hi, everyone, and thank you so much for joining us for day 2 of Emerge Live. As always, I hope that you found today's content engaging and that you're planning to come back tomorrow. As we wrap up today, I'm joined by my colleagues, Josh Sledge, Senior Director of Programs at the Financial Health Network, and John Thompson, our Chief Program Officer. Josh and John, you both moderated some really terrific sessions today. Thank you so much for participating. I'd love to hear from both of you on what themes or ideas really stood out for you today during our discussions on stabilizing communities. I'll start with an observation that I had that actually came after listening in to most of the sessions today. That I really caught a sense of optimism, that there is a lot of opportunity for organizations and individuals across a lot of different types of sectors to make some really substantial change at this moment in time for communities. So I walked away from it feeling really hopeful and thoughtful, but I'd also love to hear from you. So I'll start with Josh. And yeah, Josh, just give us a sense of what really stood out to you today.
Yeah, thanks, Laura, and thanks as well to all the panelists that participated today. It was a really great session and discussions. A few things jumped out at me. Number one, there's a really interesting dynamic between what community means in a time where everything is moving to digital. More and more, we're seeing that there's some capabilities that are offered through that. You know, we heard Maurice talking about how tech really matters and enables the work, and a great session about the opportunities around digital ID and digital wallets. But at the same time, how do we make sure that these new digital tools are created equitably and to meet the needs of all people? And at the same time, acknowledge that there's still value in physically being in different communities. Raul talked about how 30% of people were still making their payments in cash, and how being in those communities really supported people with jobs and careers. I thought it was also interesting to hear a lot about navigators on the front line and how important they were, particularly right now. Michelle Jones at MMI, she did a great job explaining and helping us remember that most people haven't gone through this before. And so who are those folks like the financial coaches at LISC and GreenPath that are really working in communities to help people access the types of resources they need to manage? And the last thing I'll say is Abby Wamimo, his story about the creation being based on what he saw people doing in his own community reminded me that oftentimes when we talk about underserved communities, we talk about them as lacking. In actuality, these are oftentimes very resilient communities and people that are coming up with different strategies. They have things to add. They have value in terms of their ideas and the ways that they're approaching their financial health. So I think it's important as we think about how to support those communities, we do so as a way of recognizing their power and finding ways to support it.
That's great. No, really appreciate that. And I heard all of that as well, but thanks for highlighting. John, what about you?
Maybe two things. I think the notion that single providers really just can't do this on their own. There's not a one-stop shop or sort of singular or unitary solution that is really going to, what Josh said. That wove its way through multiple sessions. I think the other thing that stood out, frankly, Raul's smile at the beginning of the day is a great way to get started. And I think, it's awesome and he's awesome, but I also think as just a reminder of that in a time that sometimes doesn't feel like there's a lot of hope, there is hope, and we got to work at it. And we can stay focused and positive about that.
That's really great. That's awesome. Well, thanks again to both of you. And thank you to today's speakers and to all of our sponsors for helping us to create a day full of really thought-provoking content. Just a reminder, we'll be back here tomorrow at 12 p.m. Eastern Standard Time to discuss the connections between health and financial well-being. We sincerely hope to see you soon. Thanks for joining us.